Hello there, and welcome. I'm so glad you found your way here tonight. Take a moment right now to get comfortable. Adjust your pillow, let your body settle into whatever position feels right. There's no rush. We have all the time in the world. Where in the world are you watching from? A quiet bedroom as the night deepens, a cozy corner where the weight of the day is finally lifting. Wherever you are, you're exactly where you need to be. Tonight we're going to explore one of the most dramatic single days in financial history. October 19th, 1987, the day the stock market lost $500 billion, the day that became known as Black Monday. We'll discover what led to that moment, walk slowly through the day itself, and understand what changed afterward. We'll meet the people who lived through it, examine the mechanisms that caused it, and contemplate what this teaches us about markets, technology, and human nature. But don't worry, this isn't going to be a frantic recounting of financial chaos or a sensational exploration of panic. Instead, we'll move slowly and carefully through the 1980s, through the warning signs, through that Monday in October, and through the recovery that followed. We'll take our time with the numbers, the stories, the mechanisms that mattered. By the end, I think you'll find that Black Monday was less about a single catastrophic day and more about what happens when markets, technology, and human psychology interact in unexpected ways. If you enjoy these calm explorations of financial history, like and subscribe really helps reach others seeking the same peaceful way to end their day. And to those already subscribed, thank you for being part of this community of thoughtful listeners. So settle in. Let your shoulders drop away from your ears. Take a slow breath, in through your nose, out through your mouth, and let's begin our slow drift through the 1980s, through the rise of the greatest bull market America had seen in decades toward understanding. There's nowhere you need to be, no deadlines to meet. Just listen and let the story unfold like a long, quiet conversation between old friends. Let it wash over you. If you drift away, that's perfectly fine. That's what we're here for. Let's begin in 1982 when something remarkable started to happen. The early 1980s had been difficult for America. The economy was emerging from a painful recession. Interest rates had soared to levels that seem almost unimaginable today. The prime rate, the rate banks charged their best customers, had reached 21.5% in 1980. Think about that for a moment. If you wanted to borrow money to buy a house or start a business, you might pay interest rates above 20%. The economy had been choked by these high rates, deliberately imposed by the Federal Reserve under Chairman Paul Volcker to break the back of inflation that had plagued the 1970s. Inflation had indeed been tamed. But the cost was severe. Unemployment reached nearly 11% in late 1982. Factories closed, small businesses failed. The auto industry was devastated. The pain was real and widespread. But by the summer of 1982, Volcker's medicine was working, inflation was falling, and the Federal Reserve began cautiously to lower interest rates. On August 12, 1982, something shifted. The stock market, which had been depressed for years, began to rise. Not dramatically at first, just a good day, then another good day, then a good week. The Dow Jones Industrial Average, that famous index of 30 major American companies, stood at 776 points in August of 1982. That's where we'll start our story, at 776. Because over the next 5 years, something extraordinary would happen to that number. The rise was steady at first, then accelerating. Investors who had been burned in the 1970s, who had watched their portfolios stagnate for years while inflation ate away at their purchasing power, began to believe again. Maybe stocks were a good investment after all. Maybe this time was different. Maybe the economy really had turned a corner, and in many ways, it had. The 1980s brought profound changes to America. Ronald Reagan had been elected president in 1980, bringing a philosophy of lower taxes, less regulation, and faith in free markets. Whether you agreed with his politics or not, there's no question that the mood changed. After the malaise of the late 70s, there was a renewed sense of possibility, of optimism, of American dynamism. Quote, as Reagan's 1984 campaign put it, many people felt it, believed it, invested based on it. Corporate America was transforming too. Hostile takeovers became common, one company buying another against the wishes of the target company's management. Leveraged buyouts emerged, where investors would buy entire companies using borrowed money, restructure them, and sell them for profit. A man named Michael Milken pioneered the use of high-yield bonds, called junk bonds by critics, to finance these deals. Suddenly, companies worth billions of dollars could be bought and sold like commodities. This was controversial. Of course, critics said it was destroying American industry, that companies were being carved up for short-term profit with no regard for workers or communities. Supporters argued it was making American business more efficient, forcing bloated companies to become leaner and more competitive. Both sides had points. What's undeniable is that it created enormous fortunes for some people and generated tremendous excitement on Wall Street. The culture of Wall Street itself was changing. Investment bankers and traders, once relatively modestly compensated professionals, began earning salaries and bonuses that seemed astronomical. A good year might mean millions of dollars in bonuses. Young people graduating from elite universities flocked to Wall Street, attracted by the money and the excitement. The movie Wall Street would come out in 1987, with Michael Douglas playing Gordon Gekko declaring greed is good, and while the film was meant as criticism, many on Wall Street took it as validation. But our story isn't really about Wall Street culture or corporate takeovers, though these were part of the atmosphere of the times. Our story is about the stock market itself, and what happened to it between 1982 and October of 1987. Let's talk about technology, because this is crucial to understanding what would eventually happen. The early 1980s saw the arrival of personal computers in offices and homes. The IBM PC launched in 1981. Apple was growing. Suddenly, individuals could run their own financial software, track their own portfolios, analyze stocks using programs they could run on machines that sat on their desks. Information that once required calling a broker or visiting a library became available at the touch of a few keys. Trading itself was becoming electronic. For most of stock market history, trading had been done by humans on trading floors, specialists who maintained markets in particular stocks, brokers who executed orders, traders who shouted and gestured and made deals face-to-face. This was still the dominant system in the mid-80s, but computers were entering the picture. Orders could be routed electronically. Prices could be updated in real time on computer screens rather than on chalkboards. Computer programs could be written to execute trades automatically based on certain conditions. This led to something called program trading. Here's how it worked, in simple terms. Sophisticated investors, usually institutions like pension funds or mutual funds, would use computer programs to execute large trades across many stocks simultaneously. The programs would monitor price relationships between stocks and stock index futures, contracts that let you bet on the future price of an index like the S&P 500. When these prices got out of alignment, the programs would automatically buy one and sell the other to profit from the discrepancy. This was called index arbitrage, and it was supposed to make markets more efficient, keeping prices in line across different markets. Another innovation was called portfolio insurance. This is important, so let's take our time with it. Portfolio insurance was a strategy that was supposed to protect investors from market declines. Here's the basic idea. Imagine you own a large portfolio of stocks, and you're worried about them falling in value. You could buy insurance against that decline. Specifically, you could buy put options, which give you the right to sell stocks at a predetermined price. If the market falls, your stocks lose value, but your put options gain value, offsetting the loss. But put options cost money, and large investors wanted protection without paying those costs. So some clever financial theorists, this was mostly developed by two men named Hayne Leland and Mark Rubinstein at the University of California, Berkeley, figured out you could replicate portfolio insurance synthetically. Instead of buying put options, you could achieve the same effect by selling stock index futures as the market fell. Sell a little as the market drops a little, sell more as it drops more. This dynamic hedging strategy was supposed to protect your portfolio just like real insurance. It seemed brilliant. Institutional investors loved it. By 1987, billions of dollars in assets were being managed using portfolio insurance strategies. The investors felt protected. They believed they could participate in market gains but be shielded from major losses. It was, they thought, the best of both worlds. Let me pause here and invite you to take a breath. We're building understanding slowly, piece by piece. These technical details, program trading, portfolio insurance, index arbitrage, might seem dry, but they're essential to understanding what happened on that Monday in October. So stay with me or drift away if you need to. We'll continue either way. The stock market kept rising through 1983, 1984, 1985. The Dow crossed 1,000, then 1,500, then 2,000. Each milestone was celebrated. The bull market was the longest and strongest in modern history. And here's the thing. It didn't seem crazy at the time. Corporate profits were growing. The economy was expanding. Unemployment was falling. Inflation stayed low. The fundamentals, as market analysts say, supported higher stock prices. Retail investors, ordinary people, not just institutions, were participating in unprecedented numbers. Discount brokerages had emerged in the 1970s and grown in the 80s, making it cheaper and easier for individuals to buy and sell stocks. Charles Schwab, founded in 1974, grew explosively. Fidelity's mutual funds became household names. People who had never owned stocks before were opening accounts, buying mutual funds, participating in the great bull market. There was a democratization happening, a sense that the stock market wasn't just for the wealthy anymore. Your neighbor might mention their stock portfolio at a backyard barbecue. Financial news became popular entertainment. Personal finance magazines proliferated. This was before the internet, before CNBC would transform financial television in the 1990s. But information was becoming more accessible, and investing was becoming almost mainstream. By the summer of 1987, the Dow had reached heights that seemed remarkable. On August 25, 1987, it peaked at 2,722 points. Remember, we started this story at 776 points in August of 1982. In 5 years, the market had more than tripled. That's a gain of about 250%. If you'd invested $10,000 in a Dow index fund in August of 82, you'd have about $35,000 by August of 87. Stories circulated of ordinary people who had built substantial wealth. The dentist who had invested his savings wisely. The teacher who had stuck with her mutual fund through the years. The young couple who had put money into stocks instead of leaving it in a savings account. These weren't myths. They were real people who'd benefited from the bull market. Their success encouraged others to invest. The market kept rising, and rising prices encouraged more people to buy, which pushed prices higher still. A self-reinforcing cycle of optimism and gains. Was the market overvalued by the summer of 1987? This is a question that analysts debated then and still debate now. Price-to-earnings ratios, a common measure of whether stocks are expensive or cheap, calculated by dividing a stock's price by the company's earnings per share, were elevated but not absurdly so. Some sectors were more expensive than others. Technology stocks commanded premium valuations. Financial stocks had soared on the merger and takeover boom. But you could make a reasonable case that stock prices were justified by economic fundamentals. Still, there were worries. Interest rates had been rising slowly through 1987. The Federal Reserve, now under new chairman Alan Greenspan, who had taken over from Paul Volcker in August of 1987, was concerned about the economy overheating. When interest rates rise, bonds become more attractive relative to stocks, and the math of stock valuation changes. Companies' future earnings are worth less in today's dollars when interest rates are higher. So rising rates were a headwind for the market. There were also international tensions. The United States was running large trade deficits, importing far more than it exported, particularly with Japan and Germany. The dollar had been falling against other currencies, which created its own tensions. The major economic powers, the Group of Seven or G7 industrialized nations, were trying to coordinate their economic policies, but there were disagreements, particularly between the United States and Germany over interest rates and currency values. None of these worries seemed catastrophic. They were the normal concerns that markets always face. The bull market had survived worries before and kept rising. Most investors, most analysts, most market participants believed the good times would continue. Maybe there would be a correction at some point, a drop of 10 or 15% to let off some steam. But nothing serious was anticipated. And so, the summer of 1987 passed into autumn. September saw some volatility, some ups and downs, but nothing alarming. Early October brought more significant drops, which we'll discuss in detail soon, but still nothing that suggested catastrophe was imminent. The mechanisms we've discussed, program trading, portfolio insurance, the electronic systems, the interconnected global markets, were all in place, humming along, mostly invisible to average investors who just saw their portfolio statements and were happy with the gains. Let me describe what it felt like to be an investor in October of 1987, before the crash. You might have a brokerage account with Charles Schwab or Fidelity or Merrill Lynch. You'd receive monthly statements in the mail showing your holdings and their values. You might call your broker occasionally to place a trade or ask for advice. If you wanted to check stock prices during the day, you might call your broker's office and ask them to look it up, or you might check the newspaper the next day for closing prices. Real-time price information wasn't readily available to most people. You'd feel pretty good about your investments. The market had been going up for 5 years. You'd heard stories of people making money. Your own portfolio had grown. Maybe you were saving for retirement, or a child's college education, or just building wealth. The stock market seemed like a smart place to be. Sure, there were risks. Everyone knew stocks could go down, but the long-term trend was clearly positive. Financial advisors preached the gospel of long-term investing, of staying the course, of not trying to time the market. And that advice had been proven right by 5 years of gains. Professional investors, portfolio managers, pension fund managers, institutional investors had a more sophisticated view. They understood the market's mechanisms better. They had access to better information, better research, better technology. But they too were mostly optimistic. Some were cautious, hedging their positions, using portfolio insurance strategies to protect against downside risk. Others were fully invested, riding the bull market for all it was worth. The range of views was wide, but very few expected what was about to happen. As we prepare to move into October and toward that Monday, let's remember what we've established. A 5-year bull market had created enormous wealth and brought millions of new investors into stocks. New technologies, computers, electronic trading, program trading, portfolio insurance had changed how markets functioned, though not everyone understood the implications. The global financial system was more interconnected than ever before. Interest rates were rising, creating some pressure on valuations, and human psychology. A constant factor in all market history was tilted toward optimism, toward believing that the good times would continue, toward underestimating risk. All the elements were in place. The stage was set. October was about to begin, and with it, a series of events that would culminate in the most dramatic single day in stock market history. But we'll come to that slowly, carefully, understanding each step along the way. For now, picture that late summer evening in 1987. The Dow at 2,722 near its all-time high, investors pleased with their returns, analysts projecting continued growth, the sun setting on what seemed like another successful day in the longest bull market in modern history. Everything seemed fine. Everything seemed normal. No one knew what October would bring. But underneath the calm surface of that late summer, certain pressures were building. Not dramatically, not in ways that shouted danger, but quietly, persistently, like a tide that rises so gradually you don't notice until the water is already around your ankles. Let's trace those pressures carefully, understanding what was changing beneath the surface of that seemingly endless bull market. Interest rates had been creeping upward through 1987. This matters more than it might seem, so let's take a moment to understand why. When you own a stock, you're betting that the company will earn profits in the future, and that those profits will either be paid to you as dividends or will make the company more valuable. But how much are those future profits worth today? That depends on interest rates. If interest rates are low, future profits are very valuable because you can't earn much by keeping your money in bonds or savings accounts. But when interest rates rise, suddenly those safe, guaranteed returns from bonds become more attractive, and the uncertain future profits from stocks become relatively less appealing. Through 1987, the Federal Reserve had been gradually raising interest rates. The benchmark rate, the federal funds rate, which is the rate banks charge each other for overnight loans, had risen from about 5.5% in early 1986 to over 7% by the fall of 1987. The yield on 10-year Treasury bonds had climbed from around 7% to over 10%. These weren't catastrophic moves, but they were significant. They meant that the relative attractiveness of stocks versus bonds was shifting. Alan Greenspan had just become chairman of the Federal Reserve in August of 1987, replacing the legendary Paul Volcker. Greenspan was barely 2 months into the job as October approached. He was brilliant, respected, experienced, but new to the most powerful financial position in the world. Markets were still getting to know him, still trying to understand how he would navigate difficult situations. Would he be as willing as Volcker had been to take unpopular actions if necessary? No one knew yet. There were international tensions too, the kind that sound minor in hindsight but mattered greatly at the time. The United States was running large trade deficits, meaning we imported far more goods than we exported. This was particularly pronounced with Japan, which was in the midst of an economic boom and exporting cars and electronics to America in enormous quantities. Germany, the economic powerhouse of Europe, was also running large trade surpluses with the United States. These imbalances created currency pressures. When you import more than you export, your currency tends to fall in value, which is what was happening to the dollar. A falling dollar makes imports more expensive, which can increase inflation. It also affects corporate profits. American companies that earn money abroad see those foreign earnings worth less when converted back to dollars. The major economic powers had been trying to manage these currency fluctuations through international coordination, but it was delicate work, and disagreements were common. The Dow reached its peak of 2,722 on August 25, 1987. That was the high water mark. From there, the market began to slip, slowly at first. A down day here, a down day there, nothing alarming. Through September, the market drifted lower, giving back some of its summer gains. Professional investors paid attention. Volatility was increasing, meaning the market was experiencing bigger swings both up and down. But volatility had increased before without catastrophe. It was just something to watch. Early October brought more serious declines. On Tuesday, October 6th, the Dow fell 91.5 points. That doesn't sound like much now, but remember, the Dow was around 2,500 points, so this was a drop of about 3.5% in a single day. That was large enough to make the news, large enough to worry investors. But there was no obvious catalyst, no clear reason why. The market just sold off. Portfolio managers scratched their heads. Analysts offered theories, but no one really knew. Then came Wednesday, October 14th, and Thursday, October 15th. Over these 2 days, the market fell another 95 points combined. Now we had 3 days in little over a week where the market had dropped significantly. The drops were becoming a pattern. Volatility was spiking. The VX, a measure of expected future volatility based on options prices, was climbing. Professional traders were getting nervous. Let's talk more about portfolio insurance, because this is crucial to understanding what was about to happen. Remember, portfolio insurance was a strategy where investors would sell stock index futures as the market fell, protecting their stock holdings. The theory was elegant. As stocks fell, you'd sell futures, and the profits from selling those futures would offset the losses on your stocks. You'd dynamically adjust your hedge as the market moved. But here's what the theorists who designed portfolio insurance didn't fully appreciate. What happens when everyone uses the same strategy at the same time? If one investor sells futures as the market falls, that's fine. But if billions of dollars in assets are all using the same portfolio insurance strategy, all programmed to sell futures as the market falls, then you create a cascade. The market falls a little, triggering portfolio insurance sales. Those sales push the market down more, triggering more portfolio insurance sales. It becomes a feedback loop. A self-reinforcing cycle where selling begets more selling. The academics who designed portfolio insurance had assumed that markets were liquid, that there would always be willing buyers for whatever you wanted to sell. This assumption made sense in normal conditions, but it would prove disastrously wrong when conditions became abnormal. When everyone wanted to sell at once and no one wanted to buy. Program trading added another layer of complexity. These computer programs monitored price relationships between the stock market and the futures market. In theory, the S&P 500 stock index and the S&P 500 futures contract should trade at very similar prices, adjusted for the time value of money. When they diverged, when futures became cheaper than stocks or vice versa, arbitrage programs would kick in, buying the cheap asset and selling the expensive one until prices realigned. This arbitrage was supposed to make markets more efficient, keeping different markets in sync, and it did most of the time. But when markets were falling rapidly, these programs could amplify the decline. If futures fell faster than stocks, programs would sell stocks and buy futures, pushing stocks down further. The programs didn't think or reason, they just executed their algorithms. Buying and selling based on price relationships, indifferent to whether the market was calm or chaotic. By mid-October, professional traders were aware that the market was becoming unstable. The declines of early October had shaken confidence. Volatility was high. Some portfolio managers were reducing their exposure, selling stocks to raise cash. Others were activating their portfolio insurance strategies, selling futures to protect their holdings. These actions, rational from each individual's perspective, were collectively creating pressure that would become overwhelming. Friday, October 16th, 1987. This was the last trading day before Black Monday, and it was terrible. The Dow fell 108 points, a drop of about 4.5%. This was the largest single-day point drop the market had ever experienced. Trading volume was heavy. Over 338 million shares changed hands. Far above normal levels, the market was clearly in distress. On the floor of the New York Stock Exchange, specialists, the traders responsible for maintaining orderly markets in particular stocks, were struggling. Their job was to buy when everyone else was selling, to provide liquidity to smooth out price swings. But they had limited capital. When selling pressure was intense, they could only do so much. Some stocks were seeing order imbalances, where there were far more sell orders than buy orders, and prices had to drop sharply to attract buyers. The futures market was even worse. Stock index futures were falling faster than the stocks themselves, creating unusual price relationships that triggered waves of program trading. The Chicago Mercantile Exchange, where these futures traded, was in chaos. Traders were shouting, phones were ringing constantly. Order tickets were piling up faster than they could be processed. For retail investors, ordinary people with brokerage accounts, Friday was mostly a day of confusion and rising concern. If you called your broker, you might have trouble getting through because phone lines were jammed. If you did reach someone, they might tell you the market was down sharply but not to panic, that this was just a correction, that long-term investors should stay calm. This was the conventional wisdom. After all, markets go down sometimes. Selling in a panic is usually a mistake. Better to ride it out. But some investors were spooked enough to place sell orders for Monday. Others decided to wait over the weekend and see what happened. Most people didn't do anything. They'd find out Monday evening or Tuesday morning when they read the newspaper or saw the news. Remember, this was before the internet, before smartphones, before you could check your portfolio value at any moment. For most people, investing was something you paid attention to occasionally, not constantly. The weekend would give everyone time to think, to read the news, to assess the situation. But over the weekend, events would unfold that would make Monday far worse than anyone expected. Let's talk about what happened over those 2 days. Now let me pause here for a moment. Take a breath. We're building toward understanding, but there's no rush. Let your mind rest on what we've covered. The market had been showing stress for weeks. Interest rates were rising. Portfolio insurance strategies and program trading had created potential for cascading selling. Friday, October 16th, had been bad, with the Dow falling 108 points. Professional traders were nervous, but most retail investors didn't fully understand the danger. The mechanisms that would turn a bad Friday into a catastrophic Monday were in place, but they weren't obvious to most observers. Think about the different perspectives at that moment. If you were a portfolio manager at a large pension fund, you might have been quite worried. You'd watched the market fall for weeks. You'd activated your portfolio insurance, selling futures to protect your holdings. You might have tried to reduce your stock exposure but found it difficult. When you tried to sell, you pushed prices down and buyers were scarce. You'd go home Friday evening exhausted, worried about what Monday would bring. If you were a specialist on the floor of the New York Stock Exchange, you'd be even more concerned. You'd spent Friday trying to maintain orderly markets as waves of selling hit. You'd bought stocks to provide liquidity using your own capital, and watched those stocks fall in value. You had limits to how much you could buy. If selling intensified Monday, you weren't sure you could handle it. But you'd go home Friday evening hoping the weekend would calm things down, that cooler heads would prevail. If you were a retail investor, you might have been worried, or you might not have even known yet how bad Friday was. Maybe you'd heard a news report. Maybe you were planning to call your broker Monday to see what was happening. Maybe you trusted your financial advisor's advice to stay calm and not react. You certainly didn't understand the technical mechanisms, portfolio insurance, program trading, index arbitrage. Those were inside baseball, professional trader stuff. You just knew the market had been going down and you hoped it would stop. Think too about the technology of the time. Trading was becoming electronic, but the systems were primitive by today's standards. Computer programs could execute trades, but the processing power and speed were limited. The New York Stock Exchange's systems could handle maybe 750 million shares a day at peak capacity. On a normal day, volume was around 200 million shares. Friday had seen 338 million. If volume increased much more, the systems might not be able to keep up. The telephone systems were another potential bottleneck. Investors placed orders by calling their brokers. Brokers called the exchange floor to execute those orders. When everyone tried to call at once, lines jammed. This wasn't just inconvenient. It meant orders couldn't be placed, information couldn't flow, the market couldn't function efficiently. The infrastructure of the financial system was built for normal times, not for crisis. Let's also consider the global nature of markets by 1987. The Tokyo Stock Exchange, the London Stock Exchange, exchanges across Europe and Asia. They were all connected to New York through trading relationships, through international investors who moved money between markets, through multinational corporations whose stocks traded in multiple countries. When New York had a bad day, it affected Tokyo and London. When Tokyo and London had bad days, it affected New York. Time zones meant these markets traded in sequence. Tokyo opened first, then Europe, then New York. Information and sentiment could cascade around the world, and there was one more factor that would matter enormously over the weekend and into Monday: news and how it spread. On Friday evening and through the weekend, financial news services would report on the market's troubles. Newspapers would publish articles. Television news would cover the story. Analysts would be quoted offering opinions. Some would counsel calm, others would express worry. This news would reach investors over the weekend, shaping their thinking about what to do Monday. In an era before instant communication, news travelled more slowly but also sank in more deeply. When you read a newspaper article or watched a TV news story, you had time to think about it, to discuss it with family or friends, to form an opinion. You couldn't immediately react, markets were closed, so you stewed on the information. This could amplify fear. All weekend you might worry about your portfolio, plan what you'd do Monday, perhaps decide you needed to sell. Friday evening, October 16th, as the sun set on the east coast of the United States, as exhausted traders left their offices and headed home, as investors around the country absorbed the news of a bad week and a worse Friday, the stage was set for what would happen next. All the elements were in place: the portfolio insurance strategies that would trigger massive selling, the program trading that would amplify it, the technological limitations that would prevent the market from functioning smoothly, the global interconnections that would spread the crisis, the news cycle that would shape sentiment, and perhaps most importantly, the human psychology of fear, of herd behaviour, of panic that can seize markets when conditions align just wrong. But on Friday evening, most people didn't know any of this. They knew the market had had a bad week and a worse day. They knew they were worried. But they couldn't know what Monday would bring. Some would spend the weekend anxious. Others would barely think about it. Professional traders might pull out their charts and research, trying to understand what was happening. But understanding would come too late for most of them. Let's move into that weekend now, Saturday and Sunday. October 17th and 18th. We'll watch as events unfolded, as news spread, as the crisis that would explode Monday began to take shape. We'll see how information travelled across time zones and oceans, how reactions in one market influenced others, how what seemed like an American market problem was becoming a global one. And we'll understand, slowly and carefully, how the stage was set for Black Monday, for the day when $500 billion would vanish, when the largest single-day percentage decline in stock market history would occur, when the financial system would come closer to complete breakdown than anyone at the time wanted to admit. Take another breath. Let this settle. The worst hasn't happened yet. We're still in that uncertain weekend, still in the space between knowing something is wrong and discovering how wrong it is. Rest here for a moment before we continue the story. The weekend arrived, as weekends always do, bringing with it a pause, a chance to step away from the urgency of market hours and breathe. For most Americans, this was just another October weekend. The weather was turning cooler, leaves were changing colour, families made plans, perhaps a trip to the pumpkin patch. Maybe yard work that had been put off, or simply relaxing at home after a long week. The stock market's troubles on Friday were concerning if you'd heard about them, but they weren't the centre of most people's attention. For professional traders and serious investors, though, this weekend felt different. They couldn't escape what had happened Friday. The 108-point drop in the Dow hung over them like a question without an answer. Was this just a correction, the healthy kind of pullback that markets experience periodically, or was it something worse? Most weekends offered a welcome break from market stress. This one offered only time to worry. Think about what weekends were like for a trader in 1987. There was no checking prices on your phone because smartphones didn't exist. There were no financial news websites to refresh constantly because the internet was still years away from mainstream use. Once the market closed Friday at 4 o'clock in the afternoon Eastern Time, that was it. You were cut off until Monday morning. The only information you'd get would come from newspapers, from television news programs, maybe from phone calls with colleagues who were equally in the dark. This enforced disconnection could be peaceful in normal times. You'd spend time with family, pursue hobbies, live your life outside the market's demands. But in uncertain times, it could be torturous. You'd read the Saturday morning newspaper, looking for any analysis of what had happened Friday and what might happen Monday. You'd watch the evening news for market coverage. You'd think about your positions, your exposure, what you should do when markets reopened. But you couldn't act. You could only wait. Saturday passed quietly in the United States. The newspapers carried stories about Friday's market decline. The New York Times, the Wall Street Journal, regional papers across the country, they all covered it. Financial analysts were quoted offering various interpretations. Some said the market had simply gotten ahead of itself and was correcting to more reasonable levels. Others pointed to rising interest rates as the culprit. A few expressed deeper concern, worrying that the decline could accelerate. But most of the commentary was measured, thoughtful, not alarmist. Markets go down sometimes. This was part of investing. Stay calm, think long term. Sunday brought something unexpected, something that would matter enormously. Treasury Secretary James Baker gave an interview that was published in Sunday newspapers and broadcast on Sunday news programs. Baker was frustrated with Germany. Remember those international tensions we discussed? The United States wanted Germany to lower its interest rates to stimulate growth and reduce trade imbalances. Germany, worried about inflation, was reluctant. There had been negotiations, disagreements, diplomatic tensions. In his Sunday interview, Baker essentially threatened Germany. He suggested that if Germany wouldn't cooperate on interest rates, the United States might not continue supporting the dollar. This was a significant statement. International currency stability depended on cooperation among major economies. Baker was saying in effect that the United States might let the dollar fall if Germany didn't do what we wanted. This would hurt Germany's export-driven economy, but could also create financial instability more broadly. Baker's comments would be interpreted by many as a sign that international economic cooperation was breaking down, that the carefully managed currency relationships might come apart, that the financial authorities who were supposed to be guiding the global economy were at odds with each other. In a stable market, such comments might have been shrugged off as diplomatic posturing. But in an unstable market, already nervous and looking for reasons to sell, they would be taken as a red flag. Here's where global time zones become crucial to our story. While most Americans were enjoying their Sunday on the other side of the world, it was already Monday morning. The Tokyo Stock Exchange opened for trading at 9 o'clock Monday morning Tokyo time, which was 7 o'clock Sunday evening in New York. The Japanese market had closed Friday before the worst of the New York selling. So Tokyo traders were opening Monday with Friday's New York losses and Baker's Sunday comments weighing on them. Tokyo fell immediately. Japanese investors, spooked by what had happened in New York and worried about Baker's statements, sold. By the end of Tokyo's Monday trading session, the Nikkei 225, Japan's major stock index, had fallen 2.4%. That might not sound catastrophic, but it was significant, and it established a pattern. New York had a terrible Friday. Now Tokyo was having a bad Monday. The selling was spreading. A handful of traders and market professionals in the United States were watching this unfold Sunday evening. The most dedicated, or most worried, would have stayed in their offices or set up at home to monitor international markets. This wasn't easy. You couldn't pull up a website. You might have a Reuters or Bloomberg terminal if you worked for a major firm, a specialized piece of equipment that displayed financial data. Or you might rely on phone calls to colleagues in Tokyo or London, piecing together information about what was happening on the other side of the world. Those who were watching Tokyo fell on Sunday evening knew Monday in New York was going to be difficult. The selling that had started Friday was continuing, spreading across the globe. But most people, most investors, most traders, even many professionals weren't watching. They were with their families, enjoying their Sunday, unaware that on the other side of the world the crisis was accelerating. As Tokyo's trading session ended and the Asian day moved forward, attention shifted to Europe. London, Frankfurt, Paris, the major European financial centres, would open for trading Monday morning their time, which was still the middle of the night in New York, 4 or 5 o'clock in the morning. Again, only the most vigilant or most worried Americans would be awake to watch. London opened sharply lower. The Financial Times Stock Exchange Index, the FTSE, pronounced Britain's main market index, fell hard from the opening bell. Selling was intense, volume was heavy, and prices were cascading downward. The pattern was continuing, New York down Friday, Tokyo down Monday, now London down Monday. Each market's decline was feeding into the next, creating a wave of selling that was travelling around the world following the sun. Frankfurt and Paris showed similar patterns. German and French investors, seeing what had happened in New York on Friday and in Tokyo and London on Monday morning, were selling. European markets were interconnected with American markets through multinational corporations, through international investment funds. Through the simple psychology of watching what was happening elsewhere and reacting. By the time most Americans were waking up Monday morning, pouring coffee, getting ready for work, perhaps glancing at the morning newspaper, the global financial system had already been under intense selling pressure for hours. But unless you were a professional trader or a dedicated financial news follower, you probably didn't know this yet. You might know that Friday had been bad. You might have some vague sense that markets were troubled. But you didn't know that Tokyo had fallen 2.4%, that London was in free fall, that European markets were cascading lower. The futures markets provided another early warning signal that Monday morning. Stock index futures, contracts that trade on the Chicago Mercantile Exchange, representing bets on where stock indices will be, opened before the New York Stock Exchange opened. On a normal Monday morning, futures might open at 9 o'clock. Half an hour before the stock market's 9:30 opening, traders and portfolio managers would check futures prices to get a sense of how stocks might open. Monday morning, October 19th, futures opened sharply lower. The S&P 500 futures, which represent the 500 largest American stocks, were indicating that stocks would open down several percent. This was alarming. A gap down of several percent at the opening meant billions of dollars in losses right out of the gate, before any trading had even occurred in stocks themselves. Professional traders arriving at their offices Monday morning in New York and Chicago, in financial centers across America, saw the futures prices and knew immediately that the day was going to be terrible. The selling that had started Friday, that had continued through Tokyo and London, was about to hit New York, and New York was the center of the global financial system. The New York Stock Exchange was the world's largest stock market. What happened there would matter more than what happened anywhere else. Portfolio managers began making calculations. Those who had portfolio insurance strategies knew their models would trigger selling. How much selling depended on how far the market fell, but it would be substantial. Some tried to get ahead of it, placing sell orders before the market opened, hoping to exit at better prices. But if everyone was trying to sell at once, prices would only fall further. Specialists on the floor of the New York Stock Exchange, the traders responsible for maintaining orderly markets in particular stocks, were reviewing the order imbalances in their stocks. An order imbalance occurs when there are far more buy orders than sell orders, or vice versa. Monday morning there were massive sell imbalances in almost every stock. Millions of shares that people wanted to sell, but where were the buyers? Specialists would have to buy stock themselves to maintain orderly markets, but they had limited capital. This was going to be difficult. the clerks and support staff who made the exchange function, the people who processed orders, who recorded trades, who kept the vast machinery of the market running, were preparing for an extraordinarily busy day. Trading volume on a normal Monday might be 200 million shares. Friday had been 338 million. Monday might be even higher. Could the systems handle it? No one was entirely sure. Meanwhile, retail investors, ordinary people with brokerage accounts, were mostly just starting their days. Some had heard news reports about international markets being down. Others hadn't heard anything yet. Many wouldn't even try to check their portfolios or call their brokers until later in the day, after work, perhaps that evening. The idea of checking your investments constantly throughout the day wasn't common practice. You were supposed to be a long-term investor, not someone who obsessed over daily fluctuations. But those who did call their brokers Monday morning, and many did, either because they were worried about Friday's drop or because they'd heard disturbing news over the weekend, often couldn't get through. Brokerage phone systems were jammed. Thousands of clients trying to call at once, all asking the same questions. What's happening? Should I sell? What should I do? The brokers themselves often didn't have good answers. They knew the market was going to open sharply lower, but beyond that, everything was uncertain. Think about that uncertainty for a moment. Imagine you're an investor with a significant portion of your savings in stocks. You'd watched the market triple over 5 years. You'd felt secure, perhaps even pleased with yourself for being savvy enough to invest. But Friday was terrible, and now it's Monday morning and you're hearing that things might be worse. You try to call your broker, but the line is busy. You try again. Still busy. You can't get through. You can't get information. You can't place an order even if you wanted to. You're trapped, watching your wealth potentially evaporate and unable to do anything about it. This feeling, this helplessness, this inability to act or even to get information would be experienced by millions of investors Monday. The infrastructure of the financial system simply couldn't handle the volume of people trying to access it simultaneously. Phone lines jammed, computer systems slowed, order processing bottlenecked. The market was approaching something close to dysfunction even before trading officially began. By 9:15, 9:20 Monday morning, just minutes before the opening bell, it was clear to everyone in the financial world that this was going to be an extraordinarily difficult day. Futures were indicating a gap down of 4 to 5%. International markets had been hammered. Selling pressure was massive. Order imbalances were extreme. The systems were straining. And the psychology, the collective mood of fear and uncertainty, was pushing everyone toward the exits at once. But the market hadn't opened yet. The New York Stock Exchange would open at 9:30 as it always did. The opening bell would ring, trading would begin, and then everyone would discover just how bad things could get when all the mechanisms we've discussed — portfolio insurance, program trading, global interconnections, technological limitations, human psychology — aligned in the worst possible way. The morning would unfold in ways that no one had quite imagined possible, that the models and theories hadn't predicted, that would later be analysed and studied and debated for decades. As 9:30 approached, as traders positioned themselves on the exchange floor, as brokers tried to manage panicking clients, as computer systems prepared to process what would be an unprecedented volume of orders, there was a moment of terrible anticipation. Everyone knew it would be bad. No one knew how bad. The opening bell was about to ring on the worst day in stock market history. The opening bell rang at 9:30 on Monday morning, October 19th, 1987, just as it had every trading day for decades. The familiar sound echoed across the floor of the New York Stock Exchange, a sound that usually marked the beginning of orderly business, of professional traders going about their work, of the markets performing their essential function of allowing buyers and sellers to meet. But this morning, that bell marked the beginning of something unprecedented. Many stocks didn't open immediately. This is important to understand, so let's take a moment with it. Under normal circumstances, when the opening bell rings, specialists who maintain markets in particular stocks would have balanced their buy and sell orders and would begin trading immediately. But Monday morning, the order imbalances were so extreme that specialists couldn't open many stocks right away. They needed time to find price levels where there would be enough buyers to absorb the selling. So some stocks, major, important stocks, simply didn't trade at the opening. Their prices from Friday's close were still displayed, but no trading was occurring. Investors who wanted to sell these stocks couldn't. They were frozen, watching, waiting for their stocks to open, not knowing what price they'd get when trading finally began. This added to the sense of dysfunction of a market that wasn't operating normally. The stocks that did open immediately fell sharply. Some opened down 5% from Friday's close, others down 7, 8, 10%. These weren't gradual declines. These were gap openings, where the first trade of the day was dramatically below the previous day's close. If you owned those stocks, you'd lost that percentage of your wealth instantly before you could even react. The Dow Jones Industrial Average, which tracks 30 major American companies, was calculated based on the prices of those 30 stocks. But if some of those stocks weren't trading yet, the Dow couldn't be accurately calculated. The quote boards displayed partial information. The ticker tape, that famous ribbon of paper that printed out stock prices, was almost immediately running behind. Unable to keep up with the volume of trades, information, the lifeblood of markets, was already becoming scarce and unreliable. Within the first 50 minutes of trading, it was clear that the selling pressure was enormous. Every stock that managed to open was falling. Volume was extraordinarily heavy. The specialists on the floor were buying stock, trying to maintain orderly markets, but they were being overwhelmed. Imagine you're a specialist responsible for maintaining a market in a particular stock, let's say a major industrial company. Your job is to buy when everyone else is selling, to provide liquidity, to prevent prices from falling too fast. But you have limited capital, and the selling just keeps coming. You buy 1,000 shares, the price stabilizes for a moment, then another 10,000 shares come in to sell. You buy more, depleting your capital. And still the selling continues. This was happening simultaneously across the floor in dozens of stocks. Specialists were using their own money, their firm's money, trying to slow the decline. But there were limits to how much they could buy. And as their capital was exhausted, there was less and less to cushion the fall. Prices began dropping more rapidly in larger increments. A stock might fall $1, then another $1, then $2 in quick succession. The declines were accelerating. Let's talk about what was happening mechanically, what systems were triggering what actions, because this is crucial to understanding why the morning was so chaotic. Portfolio insurance strategies, which we've discussed, were activated immediately. These computer models saw that the market was falling and automatically generated sell orders for stock index futures. Remember, the theory was that selling futures would protect your stock holdings. But when billions of dollars in assets all execute the same strategy simultaneously, the futures market is flooded with sell orders. The futures market, trading at the Chicago Mercantile Exchange, not in New York, fell faster than the stock market itself. This created unusual price relationships. Stock index futures were trading at prices that suggested stocks should be lower than they actually were. This triggered the program trading systems we discussed earlier. These computer programs saw the discrepancy and automatically started selling stocks and buying futures, trying to profit from the price difference. So now you had portfolio insurance selling futures and program trading selling stocks. Two massive sources of selling pressure, both computer-driven, both operating simultaneously. The specialists and market makers who were supposed to absorb this selling couldn't keep up. Liquidity, the ability to buy or sell quickly without dramatically moving the price, was disappearing. In a liquid market, if you want to sell 1,000 shares, you can find a buyer at a price close to the last trade. But in an illiquid market, you might have to accept a price significantly lower to find a buyer. Monday morning. The market was becoming increasingly illiquid. Selling pressure was overwhelming the limited buying interest. By 10 o'clock, just 30 minutes into trading, the Dow was down over 150 points. Remember, Friday's devastating drop had been 108 points for the entire day. Monday had exceeded that in half an hour. The decline was about 6% in 30 minutes. At this rate, the market would be down 20% or more by day's end. Some traders began to wonder if the market should be closed, if trading should be halted to let things settle, but there was no mechanism for this. Circuit breakers, automatic trading halts triggered by large declines, didn't exist yet. They would be created in response to Black Monday, but on Black Monday itself there was no way to stop the cascade. Think about what this felt like for different people in the market. If you were a portfolio manager at a mutual fund or pension fund, you were watching the value of your portfolio plummet. Your portfolio insurance strategy was supposed to protect you. But you couldn't tell if it was working because the futures market and stock market were both falling. You were getting margin calls, demands to deposit more money to cover your futures positions. You were trying to decide whether to sell more, to hold, to do something, anything, to stop the bleeding. But information was scarce, prices were delayed, phone lines to your broker were jammed. You were operating blind, making decisions with enormous consequences based on incomplete information. If you were a trader on the floor of the exchange, you were in the middle of controlled chaos. The floor was loud, always loud during trading hours, but this was different. The usual background hum of orders being shouted, deals being made, had intensified to something close to pandemonium. Traders were shouting themselves hoarse. Paper tickets, the slips used to record trades, were accumulating faster than clerks could process them. People were running, literally running, between trading posts, trying to execute orders, trying to get information. The electronic displays that showed prices were flashing constantly with updates, almost all of them showing prices falling. And yet, for all the chaos, there was also a strange professionalism. These were experienced traders, people who had worked through difficult markets before. They were scared, yes, but they were also doing their jobs, executing orders, maintaining markets as best they could, following procedures even as those procedures strained to the breaking point. There's something remarkable about watching people do their jobs under extreme pressure, maintaining discipline even as the system threatens to break down around them. For retail investors, ordinary people with brokerage accounts, the morning was mainly about frustration and fear. If you tried to call your broker, you probably couldn't get through. Phone systems at major brokerages were completely overwhelmed. Thousands of clients trying to call simultaneously, all wanting to know what was happening, many wanting to sell, some asking if they should buy the dip, most just seeking reassurance that their life savings weren't evaporating. The brokers who did answer calls often didn't have good information to give. They were seeing the same delayed quotes, the same chaotic market as everyone else. Some investors had placed stop-loss orders, instructions to automatically sell if a stock fell below a certain price. These orders were supposed to limit losses, to get you out of a stock before it fell too far. But on Monday morning, stop-loss orders added to the selling cascade. As stocks fell to trigger levels, stop orders were activated, generating more selling, pushing prices down further, triggering more stop orders. Another feedback loop, another mechanism turning normal protective measures into accelerants of the decline. The Nasdaq market, which traded smaller stocks and technology companies electronically rather than on a physical trading floor, was experiencing its own crisis. Market makers, the firms that maintain markets in Nasdaq stocks, were supposed to post prices at which they'd buy and sell. But Monday morning, many market makers were backing away from their quotes. They'd post a bid price, the price at which they'd buy, but when someone tried to sell to them at that price, they'd withdraw the quote. This wasn't illegal necessarily, but it violated the spirit of market making. It meant that for many Nasdaq stocks, there effectively was no market. You couldn't sell even if you wanted to because there was no one willing to buy at any reasonable price. Let's pause here for a moment and consider what all of this means. The stock market is supposed to be a mechanism for price discovery, for matching buyers and sellers, for allocating capital efficiently. It's supposed to be liquid, orderly, transparent. But Monday morning, the market was failing to perform these basic functions. Price discovery was breaking down because quotes were delayed and unreliable. Matching buyers and sellers was nearly impossible because there were no buyers, only sellers. Liquidity had disappeared. Order was giving way to disorder. The market was becoming dysfunctional, and yet trading continued. There was no authority that could simply shut everything down. The Securities and Exchange Commission, the government agency that oversees markets, was monitoring the situation but had limited tools to intervene. The New York Stock Exchange officials were considering closing the exchange early, something that hadn't been done since the 1930s, but were reluctant because closing might create even more panic. If the market closed, investors who wanted to sell would be trapped, and their fear might intensify. Better to let the market find its level, however painful that process might be. By 11 o'clock, the Dow was down over 200 points. The decline was continuing, accelerating if anything. Some stocks had still not opened for trading, remaining frozen hours after the opening bell. Others were trading, but with such wild volatility that prices seemed almost random. A stock might fall 3%, recover 1%, then fall 4% in the span of minutes. The normal patterns, the usual rhythm of markets where prices move up and down but follow some logic, some connection to news and fundamentals, were absent. Program trading was reaching extraordinary levels. Computer systems were executing thousands of trades, selling stocks and buying futures or selling futures and buying stocks, trying to profit from or hedge against price discrepancies. The volume of program trading would later be estimated to have accounted for a significant portion of Monday's volume. These weren't human decisions based on judgment about whether stocks were overvalued or undervalued. These were algorithms responding to price signals, creating a machine-driven cascade that fed on itself. The futures market in Chicago was in some ways even more chaotic than the stock market in New York. Futures trading involves leverage. You can control a large position with a relatively small amount of money. This magnifies both gains and losses. Monday morning, futures traders were experiencing devastating losses. Margin calls were going out constantly. Some traders were being wiped out, their accounts emptied as losses exceeded their capital. The floor of the Chicago Mercantile Exchange was a scene of shouting, confusion, desperation. Traders trying to execute orders, trying to close positions, trying to survive. The relationship between the futures market and the stock market was breaking down in ways that hadn't been anticipated. Arbitrage programs were supposed to keep the two markets in sync, but the volume and speed of decline overwhelmed the arbitrage mechanisms. At times, futures were trading at prices that implied stocks should be 10 or 15% lower than they actually were. This shouldn't happen. The arbitrage should eliminate such discrepancies. But it wasn't happening because the systems couldn't process orders fast enough, because liquidity had disappeared, because the normal mechanisms of the market were failing. Midday was approaching, and there was no sign of the selling letting up. Usually in a market decline, there comes a moment when bargain hunters step in. Investors who think prices have fallen too far, who see value, who are willing to buy. These buyers provide support, put a floor under prices, and the decline stabilizes or reverses. But Monday morning, there were no bargain hunters. Anyone with money to invest was standing aside, watching, waiting to see if the decline would continue. Why buy stocks at 10 o'clock when they might be cheaper at 11 o'clock or noon or tomorrow? This absence of buyers is perhaps the most frightening aspect of a market panic. In normal times, markets function because for every buyer there's a seller, and they meet at a mutually agreeable price. But in a panic, everyone wants to be a seller, and no one wants to be a buyer. The price mechanism breaks down. Stocks aren't worth what they were worth yesterday or an hour ago or even 15 minutes ago. They're worth whatever price someone will pay right now, and that price keeps falling because no one is willing to pay. Professional investors were experiencing a kind of existential crisis. The models they relied on, the theories they'd learned, the strategies they'd implemented, none of them seemed to work in these conditions. Portfolio insurance was supposed to protect you, but it was contributing to the decline. Diversification was supposed to reduce risk. But everything was falling together. Long-term fundamental analysis was irrelevant when prices were being driven by mechanical selling. The comfortable assumptions that guided professional investing were being shattered. And still, through all of this, life went on in the rest of the world. People were at their jobs in offices and factories and stores, mostly unaware of the financial catastrophe unfolding. Some might have heard a news report. Others would find out that evening. For most Americans, Monday morning was ordinary, getting kids to school, commuting to work, going about daily routines. The crisis on Wall Street hadn't yet touched Main Street. That would come later, if at all. For now, it was confined to the financial system, to the professionals and investors whose wealth and livelihoods were tied to the market. But the consequences, if the market collapse continued, would eventually reach everyone. Stock market declines destroy wealth, which reduces spending, which hurts businesses, which leads to layoffs. Pension funds that invest in stocks would see their assets decline, threatening retirement security. Banks that had lent money to investors might face defaults. The financial crisis could become an economic crisis, could spread from Wall Street to Main Street, from the markets to the real economy. This had happened in 1929, when a stock market crash led to the Great Depression. Could it happen again in 1987? No one knew, but the possibility was becoming frighteningly real as the morning wore on and the decline continued unabated. As the clock moved toward noon, as the first half of the trading day neared its end, the Dow was down over 250 points, approaching a 10% decline. This was already the worst day in decades. But there was no sense that the bottom had been reached, no relief rally, no stabilization. If anything, the pace of decline seemed to be accelerating. The worst was yet to come. The afternoon would be even more brutal than the morning, but we'll come to that. For now, let's rest here, in late morning, understanding what had happened so far and preparing ourselves for what would come next. The lunch hour came and went, though few people stopped to eat. On the floor of the New York Stock Exchange, traders grabbed whatever they could. A sandwich eaten while watching screens, coffee that went cold before it could be finished. There was no time for proper breaks, no respite from the relentless selling pressure. Every moment away from the trading post meant missed information, missed opportunities to execute orders, missed chances to manage the chaos that kept intensifying. By noon, the Dow Jones Industrial Average had fallen approximately 280 points from Friday's close. This represented a decline of more than 10%. 10% in a single morning. To put this in perspective, a decline of 10% in a day had not occurred since the Great Depression. This was already a historic event, already a day that would be studied and remembered, and yet the selling showed no signs of stopping. The afternoon stretched ahead. 3.5 more hours of trading, and no one knew what those hours would bring. The midday period, normally a time when trading volume might ease as traders went to lunch, remained intensely active. There was no let-up in the selling pressure. Portfolio insurance strategies continued to generate massive sell orders in the futures market. Those futures sales continued to push down futures prices, which continued to trigger program trading that sold stocks. The cascade that had begun at the opening bell was still cascading, the feedback loop still feeding back, the mechanisms that were supposed to provide stability instead amplifying the decline. Let's think about the different layers of selling that were occurring simultaneously, because understanding these layers helps us understand why the decline was so severe. First, there was fundamental selling. Investors who believed stocks were overvalued and wanted to reduce their exposure. This would happen in any decline. Then there was panic selling, investors who were scared, who didn't want to watch their portfolios lose more value, who just wanted out regardless of price. This too was normal in a sharp decline. But then there were the mechanical layers. Portfolio insurance strategies selling futures according to predetermined formulas, regardless of price, regardless of market conditions. Program trading systems selling stocks to arbitrage price discrepancies with futures. Stop-loss orders, triggering automatically as stocks hit predetermined levels. Margin calls forcing the liquidation of positions when investors couldn't meet additional capital requirements. Each of these mechanical layers operated independently of human judgment, independently of any assessment of whether stocks were actually worth less, just executing pre-programmed instructions or contractual requirements. The result was that selling begat more selling in ways that had never quite happened before. Previous market crashes had involved panic, yes, but they hadn't involved computers executing complex strategies at scale. Previous crashes had involved margin calls and forced selling, but not combined with portfolio insurance and program trading. Black Monday was revealing something new about how modern financial markets could malfunction, how technology and financial engineering could amplify rather than dampen volatility. Around 1 o'clock in the afternoon, officials at the New York Stock Exchange seriously considered closing the market early. This was an extraordinary step, one that hadn't been taken since the 1930s. Closing would mean admitting that the market could not function, that the system had broken down. It would likely create panic if the exchange itself thought conditions were so bad that trading had to stop. What would investors think? Many might interpret it as a signal that things were even worse than they appeared. But there were also arguments for closing. The specialists who maintained markets were exhausted and running out of capital. The computer systems that processed trades were straining under the volume. The ticker tape, that stream of trade information, was running hours behind. Investors couldn't get accurate information. Phones were jammed. The market was barely functioning anyway. Perhaps closing would give everyone time to catch their breath, to assess the situation, to come back Tuesday with clearer heads and better information. The discussion among exchange officials was urgent and conflicted. John Phelan, the chairman of the New York Stock Exchange, was in constant communication with his team, trying to decide what to do. The SEC was consulted. Major banks were contacted. The consensus that emerged was to stay open, to let the market find its level, however painful that might be. Closing would solve nothing and might make things worse. The decision was made. Trading would continue. But even as this decision was being made, the market was entering its most intense phase of selling. The early afternoon had seen continued heavy selling, but it was the period from roughly 2:30 to 3:30 that would see the most extreme declines. This hour would be remembered by everyone who experienced it as the darkest moment, the point where the entire system seemed on the verge of complete breakdown. Think about what was happening psychologically. By early afternoon, anyone who was watching the market, and by this point millions of people were watching through whatever means they had, knew this was an unprecedented disaster. The news media had picked up the story. Radio stations were broadcasting updates. Television networks were breaking into regular programming with market coverage. The sense that something terrible was happening had spread beyond the financial world to the general public. This awareness fed back into the market. Investors who might have been inclined to buy, to take advantage of the lower prices, held back. Why catch a falling knife, as the saying goes? Why buy when prices might fall further? Better to wait, to see if the market stabilized, to let others be the first buyers. This rational caution from each individual added up to collective paralysis. No one was willing to step in and support the market. The 3 o'clock hour brought selling that defied description. Stocks that had been falling steadily all day began to plunge. Blue-chip companies, household names, the strongest and most stable companies in America, were losing 5–10% of their value in minutes. IBM, General Electric, Coca-Cola, Exxon. These weren't speculative stocks, weren't companies with questionable fundamentals. These were the backbone of the American economy. And they were being sold indiscriminately. Volume during the 3 o'clock hour was staggering. The New York Stock Exchange's systems were processing trades as fast as they could, but it wasn't fast enough. The ticker tape, already hours behind, fell further behind. By late afternoon, the tape was showing trades that had occurred 2 or 3 hours earlier. If you were watching the ticker, you were seeing ancient history, not current prices. This information lag meant that investors were operating completely blind, making decisions based on outdated information, which only added to the chaos. The specialists on the exchange floor were fighting a losing battle. Their job was to maintain orderly markets, to provide liquidity, to buy when necessary to prevent prices from falling too fast. But during the 3 o'clock hour, this became nearly impossible. The selling pressure was too intense, too overwhelming. Specialists were using every dollar of capital they had access to, their own money, their firm's money, emergency credit lines from banks. And still it wasn't enough. Prices fell in large increments. A stock might be bid at $50, then $48, then $45 in quick succession, as specialists tried to find levels where buyers might appear. Some stocks simply stopped trading, not by official halt, not by exchange decision, but because specialists couldn't maintain a market. There were no buyers at any reasonable price. The specialists would withdraw their bid, unable to buy any more stock, and trading would pause until some equilibrium could be found. During these pauses, investors holding those stocks were completely trapped. They couldn't sell even if they desperately wanted to. They could only watch and wait and hope that when trading resumed, the price wouldn't be even lower. Let me describe what the floor of the exchange looked like during this time, based on accounts from those who were there. Imagine a large room, about the size of a football field, filled with trading posts. Each post is surrounded by traders and specialists, by screens displaying information, by phones connecting to brokerage firms. The noise level is usually high, people shouting orders, shouting bids and offers, the constant hum of thousands of simultaneous conversations. But during the 3 o'clock hour on Black Monday, the noise reached a level that was almost physically painful. Everyone was shouting. Everyone was desperate. The usual professionalism, the usual decorum, had given way to something more primal. Paper was everywhere. In 1987, trades were still recorded on paper tickets that had to be processed manually. During normal trading, clerks could keep up with the flow of paper. But Monday afternoon, the paper accumulated in piles. In drifts, tickets representing billions of dollars in transactions that hadn't yet been fully processed. People were literally wading through paper, slipping on paper tickets, pushing through drifts of paper to get from one trading post to another. And yet, even in this chaos, the market was still functioning at some level. Trades were being executed, prices were being discovered, however imperfectly. The system was bending to the breaking point, but not quite breaking. There's something remarkable about this, about the resilience of the infrastructure, even under conditions it was never designed to handle. The humans running the system, the specialists, the clerks, the exchange officials, were keeping it going through sheer determination and professionalism. The futures market in Chicago was experiencing its own version of hell. Futures traders, dealing with highly leveraged positions, were seeing losses that exceeded their entire capital. Margin calls, demands for additional money to cover losses, were coming in so fast that many traders couldn't keep up. When you can't meet a margin call, your position is liquidated automatically. You're sold out, often at the worst possible prices. Some traders were experiencing complete financial ruin in real time, watching their accounts go from positive to negative, from solvency to bankruptcy in a matter of hours. The S&P 500 futures contract, the most widely traded stock index future, saw volume that day that was several times normal levels. But more important than volume was the price action. Futures fell faster than stocks, creating the arbitrage opportunities that triggered program trading. At one point during the afternoon, futures were trading at prices that implied the S&P 500 index should be 15% lower than it actually was. This enormous discrepancy showed how disconnected the markets had become from each other, how the normal linkages and relationships had broken down. By 3:30 in the afternoon, with just 30 minutes left in the trading day, the Dow was down over 450 points. The decline was approaching 20% in a single day. This exceeded the worst single-day percentage decline from the crash of 1929. Black Monday was now officially the worst day in stock market history by percentage decline, and there were still 30 minutes of trading left. The final half hour saw no relief. Selling continued unabated. Some investors who had held on all day, hoping for a rally, finally gave up and sold. Others simply couldn't sell, their stocks weren't trading, or they couldn't get through to their brokers. The market was grinding toward the closing bell with mechanical inevitability, each minute bringing more losses, more pain, more disbelief that this was actually happening. Retail investors across the country were experiencing this in delayed and fragmented ways. Remember, if you called your broker, you might not be able to get through. If you did get through, your broker might not have current price information because the ticker was hours behind. You might place a sell order, but it would take time to execute, and the price you'd get might be far worse than the last price you'd seen. The experience was one of helplessness, of being trapped in a system that was supposed to serve you but had become almost hostile. Some people simply shut off their televisions, hung up their phones, decided they couldn't watch anymore. There was nothing they could do anyway. Their retirement accounts, their children's college funds, their nest eggs, all were losing value by the minute, and they were powerless to stop it. Better to look away, to hope that somehow things would be better tomorrow than to watch the carnage in real time. Professional investors were having parallel experiences of helplessness. Despite their expertise and resources, a portfolio manager at a major mutual fund might be watching hundreds of millions of dollars in assets disappear. They'd implemented their risk management strategies, portfolio insurance, diversification, everything they'd been taught to do, and none of it was working. Everything was falling together. The strategies designed to protect in a downturn were failing because the downturn was too severe, too fast, too overwhelming for any strategy to handle. The closing bell rang at 4 o'clock in the afternoon as it always did, with the same chime that had marked the end of trading for decades. But this closing bell marked the end of the most devastating day in stock market history. When the final numbers were calculated, and this took time because of the backlogs in processing trades, the Dow Jones Industrial Average had fallen 508 points. From Friday's close of 2,246 to Monday's close of 1,738, a decline of 22.6%. 22.6%. Let's sit with that number for a moment. If you had $100,000 invested in the stock market at Friday's close, you had $77,400 at Monday's close. More than $22,000 had simply vanished. If you had $1 million, you'd lost $226,000. The wealth destruction was almost incomprehensible in scale. The total dollar value lost from the US stock market that day was approximately $500 billion. $500 billion. This was more than the entire federal budget at the time. This was wealth that could have bought homes, funded retirements, educated children, started businesses, and it was gone, vaporized in 7.5 hours of trading. Comparisons to 1929 were inevitable. On October 28, 1929, Black Monday of that era, the Dow had fallen 12.8%. On October 29, 1929, Black Tuesday, it fell another 11.7%. Those were the worst single days of the Great Depression crash, but Black Monday of 1987, with its 22.6% decline, exceeded even those terrible days. By percentage decline, October 19th, 1987 was the worst single day in stock market history. Volume for the day was 604 million shares, more than double the previous record. The New York Stock Exchange's systems had processed this volume but barely. The ticker tape finished printing the day's trades after 9 o'clock that evening, more than 5 hours after the closing bell. For 5 hours the market was closed, but transactions were still being processed, recorded, confirmed. The machinery of the market, pushed beyond its design capacity, ground through the backlog while exhausted workers stayed late into the night. On the floor of the exchange. When the closing bell rang, there wasn't celebration or relief. There was exhaustion. Traders and specialists who had been standing and shouting for 7.5 hours simply collapsed. Some sat on the floor amid the drifts of paper tickets. Others stumbled to the edges of the room and leaned against walls. A few left immediately, desperate to get home or at least away from the scene of disaster. Most stayed, needing to finish paperwork to reconcile their trades, to figure out what positions they held and what their obligations were. The scene in the immediate aftermath was one of stunned silence broken by exhausted conversation. Traders compared notes about what they'd experienced, what they had seen. The stories were remarkably similar. Overwhelming selling, disappearing liquidity, prices falling far more than anyone had thought possible. Some traders had made money, mostly those who had been short the market or who had somehow gotten ahead of the panic. But most had lost money, and many had lost enormous amounts. News of the crash spread rapidly through the media that evening. Television news led with the story. Evening newspapers, some cities still had evening editions in 1987, ran banner headlines. Radio stations broadcast updates and analysis. For many Americans, Monday evening was when they first learned how bad the day had been. They'd known the market was down, perhaps, but the full scale of the disaster was only becoming clear as evening fell and the final numbers were released. The immediate question on everyone's mind was, what happens now? Would the selling continue Tuesday? Would this be like 1929, where the crash was just the beginning of years of decline? Would banks fail? Would businesses go bankrupt? Would jobs be lost? Would the stock market crash lead to economic depression? No one knew. The night of October 19th, as Americans went to bed, those who could sleep after such a day, the future was completely uncertain. The worst single day in stock market history had just occurred, and there was no telling what tomorrow would bring. But we'll come to tomorrow. For now, let's rest in the exhaustion of Monday evening, in the moment after the bell has rung and the desperate activity has ceased, in the strange quiet that follows catastrophe. The day was over. 508 points gone. $500 billion lost. The worst was done, at least for that day. What would happen next remained to be seen. The evening of Monday, October 19th, brought a different kind of activity, quieter than the day's chaos, but no less urgent. While most Americans were learning about the crash from evening news broadcasts, while traders and investors were trying to process what had happened, a smaller group of people was working through the night trying to prevent the crisis from getting worse. Because while Monday's trading had ended in New York, the global financial system never truly sleeps. Markets were about to open on the other side of the world, and what happened there would determine whether Tuesday would bring recovery or further catastrophe. In living rooms across America, families gathered around television sets to watch the evening news. The coverage was dominated by Black Monday. Anchors spoke in grave tones about the worst single-day decline in stock market history. Graphics showed the Dow's plunge from 2,246 to 1,738. Financial analysts were interviewed, offering various interpretations of what had happened and what might come next. The mood was somber, sometimes frightening. Comparisons to 1929 were inevitable, and those comparisons raised the spectre of another Great Depression. Imagine sitting in your living room that Monday evening watching this coverage. perhaps holding your latest brokerage statement from the end of September, showing your portfolio at its peak value. You'd know that statement was obsolete now, that your actual value was more than 20% lower. If you were retired or close to retirement, living on your investment income, this would be terrifying. If you were younger, still working, you might try to tell yourself it was just a paper loss, that the market would recover, that you shouldn't panic. But the fear would be there, gnawing at you, keeping you awake that night as you wondered what Tuesday would bring. For those more deeply involved in the financial system, Monday evening was not a time for rest, but for emergency response. In Washington, at the Federal Reserve Building, a small group of officials was working through the night. Alan Greenspan, chairman for barely 2 months, was facing the first true crisis of his tenure. He'd spent the day monitoring the markets, in contact with exchange officials, with major banks, with Treasury officials. Now he needed to decide what the Federal Reserve would do to prevent Monday's crash from becoming something worse. The danger was that the crash would create a cascade of failures in the financial system. When stock prices fall sharply, investors who have borrowed money, who are using margin, receive margin calls. They must either deposit more money or sell stocks to repay the loans. If they can't do either, they default, and the brokerage firms that lent the money are left holding losses. If enough investors default, brokerage firms can fail. When brokerage firms fail, they may default on their obligations to banks. When banks face unexpected losses, they pull back on lending, which can choke off credit to the entire economy. This contagion, this domino effect of failures, is how a stock market crash can become an economic depression. Greenspan and his team understood this danger intimately. They'd studied the Great Depression. They knew that in 1929 the Federal Reserve had failed to act aggressively enough to prevent the financial system's collapse. Banks had failed by the thousands in the early 1930s. Credit had dried up. The money supply had contracted. The Fed's passivity had turned a stock market crash into an economic catastrophe. Greenspan was determined not to repeat that mistake. But what should the Fed do? The most important tool the Federal Reserve has is its ability to provide liquidity, to ensure that banks have enough money to meet their obligations, to lend when private lenders are pulling back. During a crisis, fear causes everyone to hoard cash, to refuse to lend because they're unsure they'll be repaid. This hoarding intensifies the crisis. The Fed's role as lender of last resort is to step into that void, to provide the cash that allows the financial system to keep functioning, even when fear would otherwise freeze it. Through Monday evening and into the early morning hours of Tuesday, Greenspan was on the phone with major banks. The message was clear: keep lending. Don't pull back. If brokerages need money to meet margin calls, lend to them. If specialists on the exchange floor need capital to maintain markets, lend to them. The Fed would support the banks, would ensure they had liquidity, would stand behind them if they took losses, but they must keep the credit flowing. This was not just encouragement. This was the chairman of the Federal Reserve making commitments that carried the full faith and credit of the United States government. If banks lent money based on Greenspan's assurances and those loans went bad, the Fed would cover the losses. This was an extraordinary promise, one that would be formalized in a statement released Tuesday morning. While Greenspan was working in Washington, traders in New York and around the world were watching as Asian markets prepared to open. Tokyo would open at 9 o'clock Tuesday morning Japan time, which was 7 o'clock Monday evening in New York. Hong Kong would open shortly after. These markets had closed before the worst of Monday's selling in New York, so they would be opening to the full impact of a 508.22.6% decline in the Dow. The opening in Tokyo was brutal. The Nikkei 225 index, Japan's main stock index, fell immediately and kept falling. By the end of Tokyo's Tuesday session, the Nikkei would be down 14.9%, nearly 15% in a single day. The selling that had devastated New York was spreading, intensifying, becoming a global panic. Hong Kong's market fared even worse. When the Hang Seng Index opened Tuesday morning Hong Kong time, it plunged so rapidly that exchange officials took the extraordinary step of suspending trading. They simply closed the market, refusing to allow trading to continue because the decline was too severe, too disorderly. Stocks would be frozen for 4 days. Investors holding Hong Kong stocks couldn't sell even if they desperately wanted to. They were trapped, watching other markets fall, knowing their own holdings were probably worth far less than Friday's closing prices, but unable to do anything about it. As Tuesday morning continued in Asia, the crisis spread to other markets. Singapore, Sydney, Wellington. Every Asian exchange that was open showed heavy losses. The pattern was eerily consistent. Markets opening sharply lower, selling intensifying through the session. No relief rallies, no bargain hunters stepping in to support prices. The panic that had gripped New York on Monday was now gripping Asia on Tuesday. In New York, as Monday evening turned to Tuesday morning, a handful of traders and financial professionals were staying up through the night to watch these Asian markets. What they saw confirmed their worst fears. The crash wasn't contained to the United States. It was global. When European markets opened Tuesday morning, which would be very early Tuesday morning in New York, 3 or 4 o'clock, the selling would continue. And then, when New York opened at 9:30, the question would be whether Monday's crash would extend into Tuesday. London opened Tuesday morning showing immediate heavy losses. The FTSE 100 index fell sharply from the opening, down 6%, 7%, continuing to decline as the session progressed. Frankfurt and Paris showed similar patterns. European investors were panicking just as American and Asian investors had panicked. The sense of a global financial crisis, of a worldwide loss of confidence, was becoming overwhelming. By the time most Americans were waking up Tuesday morning, October 20th, the global markets had been in freefall for hours. Tokyo down nearly 15%. Hong Kong suspended. London down sharply. The futures markets in Chicago were indicating that US stocks would open significantly lower. The question was whether the selling would cascade the way it had Monday. Whether the mechanisms that had caused Monday's crash, portfolio insurance, program trading, margin calls, would create another day of devastation. This is where the Federal Reserve's overnight work became crucial. At 7:30 Tuesday morning, before the stock market opened, the Federal Reserve issued a short statement. It read, in full, quote 5. This statement was only 34 words, but those words mattered enormously. The Fed was publicly committing to provide whatever liquidity was necessary to prevent the financial system from collapsing. This was the signal that banks, brokerages, and investors needed to hear. It meant that the cascade of failures, margin calls leading to defaults, leading to brokerage failures, leading to bank failures, would not happen because the Fed would prevent it. Major banks had received their instructions overnight. Tuesday morning they began extending credit lines to brokerages and specialists. Continental Illinois, manufacturers Hanover, Citibank, Chase Manhattan, the major money center banks, were all providing emergency funding. If a brokerage needed cash to meet margin calls, the banks would lend it. If specialists on the exchange floor needed capital to buy stocks and maintain markets, the banks would provide it. This lending was happening at the Fed's direction, with the Fed's backing, with the implicit guarantee that the government would not let these loans fail. The stock market opened Tuesday morning with heavy selling. The Dow fell in the first few minutes of trading, down 50 points, 70 points, as Monday's panic seemed to continue, but then something changed. Buyers began to appear. Some were bargain hunters, investors who thought Monday's 22% decline had made stocks cheap enough to buy. Others were corporations buying back their own stock, trying to support their share prices. Still others were simply investors who had wanted to sell Monday, but couldn't get through to their brokers or couldn't get their orders executed, and who now, having sold, were done. The selling pressure was less intense than Monday. Around 10 o'clock Tuesday morning, the market stabilized. The Dow stopped falling. Prices held steady for a while, then began to rise, slowly at first, tentatively, as if testing whether the buying would last. But the buying continued. By midday, the Dow had recovered most of its early losses. By mid-afternoon, it was positive for the day. When the closing bell rang Tuesday at 4 o'clock, the Dow had gained 102 points, recovering about 20% of Monday's losses. Tuesday's gain of 102 points was, at the time, the largest single-day point gain in stock market history. After the worst day came one of the best days. This whipsaw, down 508 points Monday, up 102 points Tuesday, showed just how volatile and unstable the market had become. But Tuesday's gain was also enormously reassuring. It showed that the panic selling had ended, at least for now. It showed that buyers existed, that the market could function, that Monday hadn't broken the financial system. Wednesday brought another strong gain, with the Dow rising 186 points. 2 days of gains had now recovered about 60% of Monday's loss. The volatility was extreme. The market was swinging hundreds of points in either direction from day to day, but the direction was up, not down. The immediate crisis seemed to be passing. What had made the difference? Why did Tuesday and Wednesday bring recovery instead of continued collapse? Several factors mattered. First and most important was the Federal Reserve's response. Greenspan's statement Tuesday morning, backed by concrete actions to provide liquidity, prevented the cascade of failures that might otherwise have occurred. Banks kept lending, brokerages stayed solvent, the financial plumbing kept working. This was the lesson of 1929 finally learned and applied. In a financial crisis, the central bank must act aggressively to provide liquidity. Second, the automatic selling mechanisms that had amplified Monday's crash were largely exhausted. Portfolio insurance strategies had sold what they needed to sell. Many stop-loss orders had already been triggered. Margin calls had been met or positions had been liquidated. The mechanical, algorithm-driven selling that had overwhelmed the market Monday wasn't generating the same volume of selling Tuesday and Wednesday. Third, buyers were appearing. Some saw the 22% decline as an opportunity. Warren Buffett, the legendary investor, was quoted as saying that he'd been buying stocks. If someone of Buffett's stature and track record thought stocks were cheap enough to buy, other investors took notice. Corporate buyback programs, companies purchasing their own shares, provided support. Some mutual funds that had received money from investors but hadn't yet invested it saw the crash as a buying opportunity. But the recovery was fragile and incomplete. Yes, Tuesday and Wednesday brought gains, but the market remained far below its pre-crash levels. Volatility remained extreme. Trading volume, while not matching Monday's record, remained very high. The market was functioning, but it was nervous, jittery, prone to sudden swings. A piece of bad news could trigger renewed selling. Confidence had been shaken profoundly, and it would take time to restore. For individuals and institutions, the days after Black Monday were a time of reckoning and recovery. Margin calls were still being processed. Some investors couldn't meet them and were forced to liquidate positions. Some traders and small brokerages had suffered losses large enough to put them out of business. These failures were real and painful, but they were isolated rather than systemic. The financial system as a whole held together. Pension funds and mutual funds were calculating their losses and sending updated statements to investors. The numbers were sobering. A pension fund that had $50 billion in assets on Friday had roughly $39 billion on Monday evening. Even with Tuesday and Wednesday's recovery, losses remained in the billions. For retirees depending on pension income, or workers looking forward to retirement, these losses were frightening. Would their pensions be secure? Would they still be able to retire? The answers weren't immediately clear. Individual investors were dealing with their own versions of this trauma. Someone with a $100,000 portfolio on Friday had about $77,000 after Monday, perhaps $83,000 after Wednesday's close. A loss of $17,000 in 3 trading days. Some investors accepted this philosophically, reminding themselves that they were long-term investors, that they shouldn't react to short-term volatility. Others were traumatized, selling whatever they could, determined never to let this happen again. The media coverage through the week after Black Monday was intense and sometimes contradictory. Some reports emphasized the Fed's successful intervention and the market's recovery. Others warned that the crisis might not be over, that more declines could come. Financial analysts offered various interpretations. Some blamed portfolio insurance, others blamed program trading. Still others pointed to overvaluation, rising interest rates, international tensions. There was no consensus about exactly what had caused the crash or what it meant for the future. As October wore on, the market continued to fluctuate wildly, but gradually found a kind of equilibrium. By the end of October, the Dow stood at around 1,950 points, down about 300 points or 13% from before the crash, but well above Monday's low of 1,738. The month of October 1987 would end with the market down 21.5% for the month. A terrible month, historically bad, but not as bad as that single Monday had been. The psychological impact of Black Monday would last far longer than the market's recovery. Investors who lived through that day would never forget it. The sense of helplessness, of watching wealth disappear, of being unable to get information or execute orders, of feeling that the system itself was breaking down. These memories would shape behavior for years. Many investors would become more conservative, more risk-averse, more skeptical of stocks. Some would leave the market entirely, putting their money in bonds or savings accounts despite the lower returns. Professional traders and portfolio managers were similarly marked by the experience. Those who had relied on portfolio insurance strategies learned that the models could fail catastrophically when everyone used the same strategy simultaneously. Those who'd believed in diversification learned that in a true crisis, everything falls together. Those who had trusted the market's liquidity learned that liquidity can disappear when you most need it. The comfortable assumptions that guided professional investing were shattered, and new, more cautious approaches would emerge. As October ended and November began, as the immediate crisis faded into memory and assessment, one thing was clear. The financial system had come frighteningly close to complete breakdown. If the Federal Reserve hadn't acted as decisively as it did, if major banks had pulled back on lending, if the specialists on the exchange floor had been unable to maintain markets Tuesday and Wednesday, the outcome could have been far worse. Black Monday could have been the first day of a multi-week or multi-month crash that destroyed the financial system and pushed the economy into depression. That didn't happen. The system held, barely but definitely. Credit kept flowing. Markets kept functioning. The economy, remarkably, hardly noticed. There was no recession following Black Monday. Business continued more or less normally. Jobs weren't lost in large numbers. The crash remained a financial event rather than becoming an economic catastrophe. This was a tremendous success for policymakers, a vindication of the lessons learned from studying the Great Depression and applying them when crisis struck. But it was also a warning. Financial markets had evolved in ways that made them vulnerable to new kinds of crashes. Crashes driven by technology and mathematical models rather than just human psychology. The mechanisms that were supposed to make markets more efficient, portfolio insurance, program trading, computer-driven systems, had instead made them more fragile under stress. This was a problem that would need to be addressed. Changes would need to be made. We'll explore those changes and their lasting impact, but for now, let's rest in the relief of survival, in the knowledge that the worst has passed, in the gradual restoration of something like normalcy after extraordinary chaos. As the immediate crisis faded and markets found a fragile equilibrium, attention turned to a fundamental question. What exactly had happened? Why had the market fallen 22.6% in a single day? What mechanisms had failed? What had worked? Could this happen again? And if so, How could it be prevented? These weren't idle curiosities. They were urgent questions that demanded answers, because without understanding what had gone wrong, there was no way to fix it. Within days of Black Monday, multiple investigations were launched. President Reagan established a special commission, formerly called the Presidential Task Force on Market Mechanisms, but universally known as the Brady Commission after its chairman, Nicholas Brady. The Securities and Exchange Commission began its own investigation. Congressional committees announced hearings. Academic economists started analyzing the data. Everyone with expertise in financial markets was trying to piece together what had happened and why. The Brady Commission's work would prove to be the most influential. Nicholas Brady was a respected Wall Street figure, chairman of the investment bank Dillon, Read & Company. He assembled a team of experts and was given broad authority to investigate all aspects of the crash. The commission interviewed hundreds of market participants, traders, specialists, portfolio managers, exchange officials, regulators. They reviewed trading data, examining every transaction in detail. They analysed the relationships between stock markets and futures markets. They studied the role of computers and trading systems. Their goal was to create a comprehensive picture of October 19th. The work took months. Meanwhile, the market continued its nervous recovery through late 1987 and into 1988. The volatility that had characterized October gradually subsided. By the end of 1987, the Dow had recovered to around 1,950 points, still down from its August peak, but well above Black Monday's low. The financial system was functioning normally again. Life was returning to normal. But the memory of that terrible Monday remained fresh, and the demand for answers was intense. In January of 1988, the Brady Commission released its report. The document was detailed and technical, but its main findings were clear and significant. Let's walk through what the Commission discovered, taking our time to understand each piece of the puzzle. The primary culprit, the Brady Commission concluded, was portfolio insurance. Remember, portfolio insurance was a strategy that was supposed to protect stock portfolios by selling futures as stocks fell. The theory was elegant, but the practice proved catastrophic. Here's what the Commission found. As the market fell on October 19th, portfolio insurance strategies generated massive sell orders in the futures market. These weren't small trades, they were enormous, representing billions of dollars in selling pressure. The futures market simply couldn't absorb this selling without prices falling dramatically. And when futures prices fell, they created price discrepancies with the stock market that triggered program trading. Program trading systems saw that futures were cheap relative to stocks and automatically sold stocks and bought futures to profit from the difference. So portfolio insurance selling futures triggered program trading selling stocks, which pushed stock prices down, which triggered more portfolio insurance selling, which pushed futures down further, which triggered more program trading. It was a vicious spiral, a feedback loop that fed on itself. The Brady Commission estimated that portfolio insurance-related selling accounted for a significant portion of the futures selling on October 19th. Some estimates suggested that between $60 and $90 billion in assets were being managed using portfolio insurance strategies. When all of these strategies tried to sell futures simultaneously, the result was overwhelming. The futures market, which was supposed to provide a way to hedge risk to manage exposure, became instead a transmission mechanism that amplified the crash. But portfolio insurance alone doesn't fully explain Black Monday. After all, portfolio insurance had been used during market declines before without causing catastrophe. So what was different on October 19th? The Brady Commission identified several factors that came together to create the perfect conditions for a crash. First, the relationship between the stock market and the futures market broke down. Under normal conditions, arbitrage trading keeps these markets in sync. When they diverge, traders buy the cheap one and sell the expensive one, bringing prices back together. But on October 19th, the volume and speed of divergence overwhelmed the arbitrage mechanism. Futures fell so fast, so far below where stocks were trading that arbitrage couldn't keep up. The two markets became disconnected, trading almost independently, which allowed the crash to deepen in ways it shouldn't have. Second, the market infrastructure wasn't designed to handle the volume and volatility. The New York Stock Exchange's computer systems were overwhelmed. The ticker tape fell hours behind, leaving investors without current price information. The telephone systems at brokerages were jammed, preventing investors from getting through to place orders. The specialists on the exchange floor ran out of capital to maintain orderly markets. Every piece of infrastructure that needed to function smoothly under stress instead reached its breaking point. Third, there were what the Commission called 6 problems. This refers to the detailed mechanics of how markets operate, how orders are executed, how prices are set, how information flows. On October 19th, all of these mechanisms functioned poorly. Many stocks experienced delayed openings or couldn't open at all because order imbalances were too extreme. Market makers on the Nasdaq backed away from their quotes, refusing to honor their commitments to maintain markets. The normal process of price discovery, where trading activity reveals what something is actually worth, broke down because trading itself became so difficult. The Commission also found that communication between different parts of the financial system was poor. The New York Stock Exchange and the Chicago Mercantile Exchange, where futures traded, operated independently with limited coordination. When one market experienced severe stress, the other market didn't necessarily know about it in real time. This lack of communication meant that problems in one market would cascade into the other before anyone could respond. Better coordination might have allowed for a more coherent response to the crisis as it unfolded. Let's think about what all of this means. The Brady Commission was describing a modern financial market that had grown complex and interconnected in ways that created new vulnerabilities. Portfolio insurance seemed like a brilliant innovation when it was developed, a way to protect investors from losses. But when everyone used the same strategy, it became a source of instability rather than protection. Computer-driven trading seemed like progress, a way to make markets more efficient. But when computers executed trades based on price signals without considering market conditions, they amplified volatility rather than dampening it. The Commission's findings were sobering because they suggested that the very innovations that were supposed to make markets better, more sophisticated risk management, more automated trading, more interconnected global markets, had instead made markets more fragile. This was an uncomfortable conclusion. It suggested that progress in financial markets wasn't always progress, that complexity could create danger, that the same tools that worked well in normal times could fail catastrophically in crisis. But the Brady Commission also identified something crucial: why Black Monday hadn't led to an economic depression the way the 1929 crash had. The answer was the Federal Reserve's response. In 1929 and the years following, the Fed had failed to provide adequate liquidity. Banks failed, credit dried up, the economy spiraled into depression. In 1987, the Fed under Alan Greenspan acted immediately and aggressively. The statement Tuesday morning affirming the Fed's readiness to provide liquidity was exactly what was needed. Major banks kept lending, the financial system kept functioning, and the crash remained a financial event rather than becoming an economic catastrophe. This was an enormously important lesson. It validated the decades of economic research that had studied the Great Depression and concluded that the Fed's passivity had worsened and prolonged it. It showed that when central banks act decisively during financial crises, they can prevent crashes from spreading to the broader economy. Greenspan's handling of Black Monday would be seen as a triumph, as proof that the lessons of the 1930s had been learned and could be successfully applied. The Securities and Exchange Commission conducted its own investigation, focusing more on regulatory issues and market practices. The SEC's findings largely aligned with the Brady Commission's. They too identified portfolio insurance and program trading as major contributors to the crash. They too found that market infrastructure had been overwhelmed, but the SEC also made recommendations about specific regulatory changes that might prevent future crashes or reduce their severity. Congressional hearings brought market participants to Washington to testify about what they'd experienced. The specialists from the New York Stock Exchange floor described the chaos, the overwhelming selling, their struggles to maintain orderly markets with limited capital. Portfolio managers explained how their portfolio insurance strategies had worked, or more precisely, hadn't worked. Futures traders from Chicago described the panic in the futures market. These hearings were sometimes contentious, with members of Congress frustrated by what they saw as excessive risk-taking or inadequate safeguards, but they also helped educate policymakers about how modern markets actually functioned. Academic economists were analysing the crash from theoretical perspectives. Some argued that the market had simply been overvalued and October 19th was a rational correction. But this explanation had problems. If the crash was rational, why did it happen all in one day? Why the sudden recognition on October 19th that stocks were overvalued rather than a gradual decline? And why did the market recover so much of its loss in the following days if the new, lower prices were the correct ones? Other economists focused on market psychology and herd behaviour. Perhaps investors had panicked, selling not because of rational analysis but because everyone else was selling. This explanation made sense of the intensity and speed of the decline, but it didn't fully explain why the panic started when it did. What triggered it? Why October 19th rather than some other day? The most convincing explanations combined multiple factors. The market had been showing stress for weeks before October 19th. Rising interest rates, international tensions, growing volatility. These created a fragile situation where markets were primed to fall. Then, portfolio insurance and program trading, operating through computer-driven systems, amplified what might have been a moderate decline into a catastrophic crash. Market infrastructure failures made everything worse by preventing normal price discovery and making it difficult for buyers to enter the market. And throughout, human psychology, fear, panic, herd behaviour intensified the decline as investors rushed to sell regardless of price. What emerges from all these investigations and analyses is a picture of a complex system failure. Not one thing went wrong, but many things went wrong simultaneously, and they interacted in ways that made the crash worse than any single factor would have produced alone. This is often how modern crises work, not simple cause and effect, but complex interactions among multiple systems, all failing or malfunctioning at once. One crucial finding that would shape future policy was the importance of liquidity. The Brady Commission emphasized that in a crisis, markets need buyers. When everyone wants to sell and no one wants to buy, prices can fall almost without limit. The Fed's role in providing liquidity, ensuring that money's available, that credit keeps flowing, that the financial plumbing works, is essential to preventing market crashes from becoming systemic failures. This lesson would influence central bank policy for decades to come. Another important conclusion was that markets need circuit breakers, mechanisms to halt trading when declines become too severe too quickly. The idea is to give everyone time to catch their breath, to assess the situation, to let information flow and allow rational decision-making to replace panic. On October 19th, there were no circuit breakers. Trading continued straight through from 9:30 to 4 o'clock, despite the severity of the decline. The Commission recommended implementing circuit breakers that would halt trading after declines of a certain magnitude. The investigations also highlighted the need for better coordination between different markets. Stocks and futures are closely related instruments, but they traded on different exchanges with different rules and different regulators. When stress appeared in one market, it could cascade into the other, without anyone having a full picture of what was happening. Better coordination, better communication, better regulatory oversight across markets. these became clear priorities. There were recommendations about portfolio insurance and program trading as well. Some argued these practices should be banned or severely restricted. Others thought that was too extreme, that the problem wasn't the practices themselves but the lack of safeguards around them. The debate would continue, but some restrictions on program trading would be implemented, and the portfolio insurance industry would effectively collapse after Black Monday as investors lost faith in the strategies. What's striking as we look back at these investigations is how thorough they were. How seriously the financial community and regulators took the task of understanding what had happened. This wasn't just finger-pointing or blame assignment, it was genuine inquiry, trying to understand complex systems and how they had failed, so that failures could be prevented in the future. Not everything recommended would be implemented, and not every implementation would work perfectly, but the effort to learn from Black Monday was real and substantial. As these investigations proceeded through late 1987 and into 1988, the market continued its recovery. The urgency of the immediate crisis faded. Life returned to something like normal. But the memory of Black Monday remained, shaping behavior, influencing policy, reminding everyone that markets, for all their sophistication and modernity, could still fail in dramatic and frightening ways. The crash had revealed vulnerabilities in the financial system that needed to be addressed. The investigations provided a roadmap for addressing them. What remained was to actually implement the changes, to reform the system, to make markets more resilient. And that work would unfold over the years following Black Monday, changing forever how markets operate and how they're regulated. While investigations were documenting the mechanics of the crash and regulators were drafting reforms, millions of individuals were dealing with the personal aftermath of Black Monday. Behind the statistics and policy debates were human stories. People who had lost money, people who had survived, people who had learned lessons they would carry for the rest of their lives. Let's spend some time with these stories, understanding what Black Monday meant not to the market as an abstraction, but to the people who experienced it. For many individual investors, the first challenge was simply finding out how much they had lost. Remember, in 1987 you couldn't check your portfolio value instantly on a phone app. You'd receive monthly or quarterly statements in the mail. Some brokerages sent updated statements after Black Monday, but these took time to arrive. So for days or weeks after October 19th, many investors were operating with incomplete information, knowing they'd lost money but not knowing exactly how much. When the statements finally arrived, the numbers were sobering. A retirement account that had held $200,000 in early October might show $160,000 after Black Monday. $40,000 gone. For someone planning to retire in a few years, depending on that money for income, this was devastating. Would they be able to retire on schedule? Would they need to work longer? Would their retirement lifestyle need to be more modest than they'd planned? These weren't abstract questions. They affected fundamental life decisions. Some investors took the losses philosophically. They'd been taught to be long-term investors, to not react to short-term market fluctuations. They told themselves the market would recover, that the underlying companies were still valuable, that selling now would lock in losses that might otherwise be temporary. This required discipline and faith, especially in the weeks after Black Monday when it wasn't yet clear that recovery would come quickly. But for those who maintained this discipline, who stayed invested or even bought more stocks when prices were low, the eventual recovery would prove them right. Others panicked. They sold everything, determined never to let this happen again. They moved their money into bonds, into savings accounts, into money market funds that paid modest interest but were safe. They'd take the loss they'd already suffered, but they wouldn't risk losing more. For these investors, Black Monday marked the end of their relationship with the stock market. They'd tried stock investing, it had hurt them badly, and they were done. The fact that the market would eventually recover to new highs didn't help them because they weren't there to benefit. Think about what this means over decades. Someone who sold after Black Monday and moved to bonds or savings accounts would have earned perhaps 4 or 5% per year going forward. Someone who stayed in stocks would have earned perhaps 10 or 12% per year. Over 20 or 30 years, that difference compounds dramatically. The investor who stayed in stocks might have doubled or tripled their money. The investor who moved to bonds might have done okay, but nowhere near as well. So the decision made in the emotional aftermath of Black Monday, stay or leave, had consequences that lasted a lifetime. There were also those who lost everything, or nearly everything. Investors who had been using margin, borrowing money to buy stocks, faced margin calls they couldn't meet. Their positions were liquidated at the worst possible prices. Some ended up with negative account balances, owing money to their brokers. These weren't wealthy speculators necessarily. Some were ordinary people who had been told that using a little leverage could enhance returns, who hadn't fully understood the risks, who now faced financial ruin. One story that circulated after Black Monday, perhaps apocryphal but representative of real experiences, told of a dentist who had used margin heavily to invest in stocks. He'd done well during the bull market, his portfolio growing faster than it would have without leverage. But Black Monday's decline, magnified by his use of margin, wiped him out completely. He lost his entire portfolio and owed additional money besides. Years of savings gone, his retirement plans destroyed. He was in his 50s, would have to work for years longer than planned, and would never fully recover financially. Professional traders had their own experiences of Black Monday. For some, it was simply the worst day of their careers, exhausting, stressful, frightening. But survivable. They'd lost money that day, but they still had their jobs, their firms were intact, and they could move forward. The trauma was real but manageable. For others, Black Monday was career-ending. Some traders had taken large directional bets that the market would continue rising. When it crashed, they suffered losses so large their firms fired them. Their reputations were damaged. Some left the financial industry entirely, finding other careers where their past mistakes wouldn't follow them. The psychological toll of failing so publicly, of losing so much money, even if it was their firm's money rather than their own, was enormous. Some firms didn't survive. Smaller brokerages that had extended credit to clients who couldn't pay, that had taken proprietary positions that went badly wrong, that simply couldn't withstand the losses, these firms closed. Their employees lost their jobs. Their clients had to transfer accounts to other firms, a process that was disruptive and sometimes resulted in losses or complications. But there were also success stories. People who navigated Black Monday well and even profited from it. Warren Buffett, the legendary investor from Omaha, was buying stocks during and after the crash. Buffett had long preached the gospel of value investing, finding quality companies whose stock prices didn't reflect their true worth and buying them with the intention of holding for years or decades. Black Monday, from Buffett's perspective, was simply a sale, an opportunity to buy excellent companies at discounted prices. Buffett's purchases during this period would prove remarkably successful. By staying calm when others panicked, by having the cash available to invest when others were desperate to sell, by taking a long-term view when others could only see short-term disaster, Buffett demonstrated principles that would cement his reputation as one of the greatest investors of all time. And his public statements about buying stocks helped restore confidence. If Warren Buffett thought stocks were a good investment, maybe they were. Peter Lynch, the famous manager of Fidelity's Magellan Fund, had a similar experience. Lynch's fund had grown to become one of the largest and most successful mutual funds in the country. On Black Monday, he watched the fund lose billions of dollars in value. But Lynch didn't panic. He continued to invest based on his research and analysis. He looked for companies with good fundamentals that had been unfairly punished by the indiscriminate selling. His discipline and long-term perspective would pay off as the fund recovered and continued to grow. These success stories weren't just about making money. They were about demonstrating that it was possible to navigate crisis rationally, to not let fear override judgment, to maintain discipline when discipline seemed impossible. For investors watching these figures, there was reassurance in knowing that smart, experienced investors weren't panicking. This helped steady nerves and contributed to the market's recovery. Let's think about the psychological impact of Black Monday on those who lived through it. There's a concept in psychology called anchoring, the tendency to rely heavily on the first piece of information you receive about something. For investors whose first serious experience with market volatility was Black Monday, that experience became their anchor. They would forever after think of the market as something that could fall 22% in a day. This made them cautious, sometimes overly so. They might avoid stocks even when stocks were appropriate for their goals. They might over-allocate to bonds or cash. Their risk tolerance had been permanently affected by that one traumatic day. For traders and professional investors, Black Monday taught specific lessons about risk management. Many had believed their risk management systems were sophisticated and robust. Portfolio insurance was supposed to protect them. Diversification was supposed to limit losses. Stop-loss orders were supposed to get them out before losses became catastrophic. Black Monday showed that all of these tools could fail simultaneously when conditions were bad enough. The lesson was humility, recognition that risk couldn't be completely eliminated or perfectly managed, that markets could do things that models and theories said shouldn't happen. There was also a generational aspect to Black Monday's impact. Young investors who experienced it early in their investing lives learned caution. Some became so cautious they never invested aggressively, potentially costing themselves returns over decades. Others internalized the lesson that markets can crash but also recover. And they became more resilient investors because of it. The key difference was often whether they sold during the crash or stayed invested through it. For those nearing or in retirement on Black Monday, the experience was particularly difficult. These were people who couldn't afford to wait years or decades for recovery. They needed their investment income now or soon. A 22% decline in their portfolio meant a 22% decline in potential income. Some had to adjust their retirement plans significantly, spending less, perhaps returning to work part-time, delaying major purchases. The dream of comfortable retirement, carefully saved for over decades, had been damaged in a single day. But here's something important. For investors who stayed in the market, recovery came relatively quickly. By the end of 1988, just over a year after Black Monday, the Dow had recovered to new highs, surpassing its August 1987 peak. By 1989, the crash was well in the rearview mirror. Investors who had maintained their discipline, who had resisted the urge to panic sell, found their portfolios restored to pre-crash levels and then beyond. This recovery illustrated a fundamental truth about stock market investing. If you can withstand the volatility, if you can avoid selling during crashes, if you can take a long-term view, the market has historically rewarded patience. Every major crash in market history, 1929, 1987, 2000, 2008, was eventually followed by recovery to new highs. The timing varied. The path wasn't straight, but recovery came. Investors who understood and believed this were able to benefit. Those who didn't often locked in losses they didn't need to take. Think about two investors, both 55 years old on Black Monday, both planning to retire at 65, both with $500,000 invested. The first panics and sells everything, moving to bonds paying 5% per year. After 10 years, at age 65, they have about $810,000. Not bad. Their money grew by 62%. But the second investor stays in stocks despite the scary volatility. Their portfolio might have earned 10 or 12% per year over those 10 years. At age 65, they might have $1.3 million or even $1.5 million. The difference, $400,000 to $700,000 in additional wealth, came from staying invested through Black Monday rather than fleeing from it. These calculations are simplified, of course. Real-life investing is more complex. But the principle holds. The cost of leaving the market during a crash is often enormous, while the benefit of staying invested, though psychologically difficult, can be tremendous. Black Monday taught this lesson to those willing to learn it. There were also lessons about humility and the limits of knowledge. Many sophisticated investors, using sophisticated strategies, had been caught completely off guard by Black Monday. Portfolio insurance, developed by respected academics, had failed catastrophically. Computer models that were supposed to manage risk had instead amplified it. The takeaway was that no one, no matter how smart or well-credentialed, could eliminate risk or perfectly predict market behavior. The market was complex, driven by human psychology as much as by rational analysis, capable of surprising even experts. This recognition of limits led some investors to simpler approaches. Instead of complex hedging strategies or sophisticated portfolio insurance, maybe the better approach was straightforward diversification and long-term holding. Instead of trying to avoid losses through clever tactics, maybe the better approach was accepting that losses will sometimes happen and planning to withstand them. The wisdom of simplicity over complexity. This was a lesson that Black Monday taught clearly. As the months and years passed after Black Monday, as wounds healed and portfolios recovered, the crash took on a different character in memory. For those who had lived through it, it remained vivid. They could remember where they were when they heard about it, how they felt, what they did. But it also became a story they could tell, a crisis they had survived, evidence of their resilience. I lived through Black Monday became a kind of badge, proof that you'd been through the worst and come out okay. For younger investors who came to the market after Black Monday, it was history rather than lived experience. They'd heard about it, knew it had happened, but didn't carry the emotional weight of it. This created interesting dynamics. Older investors who remembered Black Monday were sometimes more cautious than younger investors who didn't. The younger investors might take risks that older investors wouldn't, either because they were bolder or because they lacked the sobering experience of watching everything fall apart in a single day. The human stories of Black Monday are ultimately stories about how people respond to crisis, loss, and uncertainty. Some responded with panic and never recovered financially or psychologically. Others responded with discipline and patience and were rewarded. Some learned lessons that served them well for decades. Others learned the wrong lessons or failed to learn at all. The market itself was impersonal, indifferent to individual circumstances. But the people in the market were very much not impersonal. They had hopes and fears, plans and dreams, strengths and weaknesses. Black Monday tested all of them, and the outcomes depended as much on character and psychology as on financial knowledge or wealth. The personal stories of Black Monday matter deeply, but so do the systemic changes that emerged in its aftermath. Because while individuals were processing their losses and learning their lessons, regulators and market officials were working to reform the financial system, to implement safeguards that might prevent another Black Monday, or at least reduce its severity. Let's explore what changed in the years following October 19th, 1987, and how those changes shaped the markets we have today. The most visible and important reform was the implementation of circuit breakers. These are automatic trading halts that trigger when the market declines by a certain percentage. The idea is simple but powerful. If the market falls too far too fast, trading stops for a period, 15 minutes, an hour, perhaps for the rest of the day, giving everyone time to catch their breath, to assess information, to make rational decisions rather than panic-driven ones. Circuit breakers were implemented in October of 1988, almost exactly 1 year after Black Monday. The initial thresholds were set at declines of 250 points and 400 points in the Dow Jones Industrial Average. If the Dow fell 250 points from the previous day's close, trading would halt for 1 hour. If it fell 400 points, trading would halt for 2 hours. These were large numbers in 1988 when the Dow was around 2,000 points. A 250-point decline represented about a 12% drop. The goal was to halt trading only in truly extreme circumstances. The circuit breaker rules have been modified several times over the years as the Dow has grown. By the 2000s, when the Dow was above 10,000 points, a 250-point decline was only about 2.5%, not enough to constitute an emergency. So the rules were changed to use percentage declines rather than point declines, and the thresholds were adjusted. Modern circuit breakers trigger at 7%, 13%, and 20% declines. Each level brings a longer halt, with a 20% decline potentially closing the market for the rest of the day. Have circuit breakers worked? This is an interesting question with a complex answer. They've been triggered a number of times, most notably during the COVID-19 pandemic in March of 2020, when multiple circuit breaker halts occurred as markets plunged. In those instances, the halts did seem to provide breathing room, allowing panic selling to pause and giving time for information to spread and for calmer minds to prevail. The halts didn't prevent large declines. The market still fell dramatically during the pandemic's early days, but they may have prevented the kind of cascading, self-reinforcing crash that characterized Black Monday. Critics of circuit breakers argue that they can make things worse by creating uncertainty. If trading is halted, investors who want to sell are trapped, and their anxiety may intensify. When trading resumes, the pent-up selling pressure might create an even more severe decline. There's also a psychological effect. The mere fact that a circuit breaker has been triggered signals that something is seriously wrong, potentially increasing panic rather than reducing it. These criticisms have some merit, but the general consensus is that circuit breakers are a useful tool, not perfect, but better than having no mechanism to pause trading during extreme volatility. Another major change after Black Monday involved coordination between different markets. Remember, one of the problems on October 19th was that the stock market and futures market were operating almost independently, with limited communication between the New York Stock Exchange and the Chicago Mercantile Exchange. Price discrepancies between the two markets triggered program trading that amplified the crash. But neither market had a full picture of what was happening in the other. Post-Black Monday reforms created better communication systems and coordination mechanisms. Regulators from both markets, the SEC overseeing stocks and the Commodity Futures Trading Commission overseeing futures, began working together more closely. Information sharing protocols were established so that if one market was experiencing severe stress, the other would know immediately. Cross-market circuit breakers were eventually implemented, meaning that if trading halts in the stock market, related futures trading can be halted as well. Margin requirements were also adjusted. Margin is the minimum amount of your own money you must have relative to the total value of your position. If margin requirements are low, you can control large positions with little money, creating high leverage. Higher margin requirements mean less leverage, which reduces the potential for catastrophic losses but also limits potential gains. After Black Monday, margin requirements were increased for certain types of trading, particularly in futures markets where leverage had been very high. This made the system somewhat less fragile, reducing the likelihood that small price movements would trigger massive margin calls and forced selling. The portfolio insurance industry effectively collapsed after Black Monday. Investors who had used portfolio insurance strategies felt betrayed. They'd been promised protection and instead had experienced catastrophic losses. The fundamental problem with portfolio insurance was that it only worked if not too many people used it simultaneously. Once billions of dollars in assets were all trying to execute the same strategy at the same time, the strategy broke down. This is sometimes called a fallacy of composition. Something that works fine for individuals fails when everyone does it together. After Black Monday, few investors were willing to trust portfolio insurance. The firms that had offered these services found their clients leaving. Some of the academic pioneers who had developed the strategies defended their work, arguing that portfolio insurance would have worked if market infrastructure had been better, if liquidity had been deeper, if implementation had been more careful. But investors didn't want to hear excuses. They wanted strategies that actually worked under stress, and portfolio insurance had failed that test. By the early 1990s, portfolio insurance as a distinct industry had largely disappeared. Program trading, computer-driven buying and selling based on mathematical models, didn't disappear, but it was restricted and reformed. The New York Stock Exchange implemented rules limiting program trading during periods of high volatility. These collars would restrict or prohibit program trading when the market moved beyond certain thresholds. The goal was to prevent computer-driven trading from amplifying market swings the way it had on Black Monday. These restrictions were controversial. Some argued they interfered with market efficiency, but they represented an attempt to manage the risks that computerized trading had revealed. Technical infrastructure was substantially upgraded in the years following Black Monday. The New York Stock Exchange invested heavily in computer systems that could handle much higher trading volumes. The ticker tape system, which had fallen hopelessly behind on Black Monday, was improved and eventually made obsolete by real-time electronic price displays. Communication systems were upgraded so that investors could more reliably reach their brokers during busy periods. The goal was to ensure that when the next crisis came, and everyone understood there would be a next crisis, the basic infrastructure of the market would be able to function. Clearing and settlement systems, the back-office processes that finalize trades and transfer securities and cash between buyers and sellers, were also improved. On Black Monday, the volume of trades had overwhelmed these systems, creating enormous backlogs and uncertainty about who owned what. Improvements in clearing and settlement made the process more automated, more reliable, and more resilient. This was technical, unglamorous work, but it was crucial to ensuring that markets could function during stress. How were these changes tested? Did they actually make markets more resilient? The years following Black Monday provided several opportunities to find out. In October of 1989, the market experienced a mini panic when a leveraged buyout deal fell apart, causing a sharp one-day decline. The drop was significant, about 7%, but nowhere near Black Monday's magnitude. Circuit breakers weren't triggered, but the market infrastructure handled the stress without breaking down. This was reassuring. The reforms seemed to be working. The Gulf War in 1991 created market volatility, but again, no crash. The Asian financial crisis of 1997, which devastated markets across Asia, created stress in US markets but not catastrophe. The collapse of long-term capital management in 1998, a hedge fund whose failure threatened to cascade through the financial system, required Federal Reserve intervention but didn't crash the stock market. Each of these events tested different aspects of the post-Black Monday reforms and generally found them adequate, though not perfect. The dot-com bubble and crash of 2000 through 2002 was a different kind of crisis, a slow-motion crash rather than a single-day panic. Technology stocks, which had soared to absurd valuations in the late 1990s, fell steadily over 2 years, with the Nasdaq Composite losing about 78% of its value from peak to trough. This was devastating for investors in technology stocks, but it wasn't a Black Monday-style panic. There was no single day of catastrophic decline. The circuit breakers weren't triggered. The crash unfolded slowly enough that market infrastructure could handle it. This suggested that the reforms had made sudden crashes less likely, though they couldn't prevent longer-term bear markets driven by fundamental overvaluation. The financial crisis of 2008 was the most severe test. The collapse of Lehman Brothers in September 2008 created panic that, for a time, threatened to overwhelm the financial system. Stock markets around the world plunged, credit markets froze, banks teetered on the edge of failure. For several weeks in September and October of 2008, the situation seemed as dangerous as anything since the Great Depression, but there were crucial differences from Black Monday. First, the decline wasn't concentrated in a single day. The worst single day in 2008 saw the Dow fall about 777 points, or nearly 9%. Terrible, but not 22%. Circuit breakers triggered a few times during the crisis, providing pauses that may have prevented even worse cascades. Second, the Federal Reserve responded aggressively and immediately, much as it had after Black Monday. The lessons Greenspan had demonstrated in 1987, that the Fed must provide liquidity during crisis, were applied again, this time by Fed Chairman Ben Bernanke. Bernanke was an academic expert on the Great Depression before becoming Fed Chairman. He understood intimately how the Fed's failures in the 1930s had turned crisis into catastrophe. When the 2008 crisis hit, Bernanke used every tool available and invented some new ones to provide liquidity, to keep credit flowing, to prevent the cascade of failures that could have turned financial crisis into economic collapse. The Fed's actions were controversial and remain debated, but they prevented 2008 from becoming another 1929, and the template for this aggressive response had been established on October 20th, 1987, when Greenspan's brief statement about providing liquidity had helped stabilize markets after Black Monday. The legacy of Black Monday extends beyond specific reforms to a broader understanding of how markets work and how they can fail. Before 1987, there was a belief, perhaps a naive one, that modern financial markets, with their sophisticated tools and theories, had evolved beyond the kind of crashes that characterized earlier eras. Black Monday shattered that belief. It showed that markets could still fail catastrophically, that sophisticated risk management could fail, that computer-driven systems could amplify rather than dampen volatility. This was a humbling lesson, and it created a permanent wariness about market stability. This wariness has influenced market design and regulation ever since. There's now a recognition that markets need safeguards, circuit breakers, margin requirements, coordination mechanisms, regulatory oversight. The libertarian view that markets left entirely to their own devices will naturally find optimal outcomes was dealt a severe blow by Black Monday. It became clear that markets, particularly modern markets with complex interconnections and computer-driven trading, need rules and structures to function reliably. But safeguards come with costs and trade-offs. Circuit breakers can prevent crashes, but also interfere with price discovery. Restrictions on program trading can reduce volatility, but also reduce market efficiency. Higher margin requirements can prevent excessive leverage, but also limit strategies that sophisticated investors might want to employ. Finding the right balance, enough regulation to prevent catastrophic failures, but not so much as to stifle innovation and efficiency, remains an ongoing challenge. The evolution of trading technology has continued, creating new challenges. High-frequency trading, computer-driven trading that operates in milliseconds, executing thousands of trades per second, has become dominant in modern markets. This is orders of magnitude faster than the program trading of 1987. High-frequency trading provides liquidity and narrows bid-ask spreads. But it also creates new risks. The flash crash of May 6, 2010, when the Dow plunged about 9% in minutes before recovering, was attributed partly to high-frequency trading algorithms interacting in unexpected ways. It was reminiscent of Black Monday, a sudden, severe decline driven by computer systems rather than human judgment. The flash crash triggered its own reforms, including additional circuit breakers and new rules around high-frequency trading. But it also demonstrated that the same fundamental problem exists today as in 1987. Computer-driven trading systems can interact in ways their designers didn't anticipate, creating market instability. The technology is faster, the systems are more sophisticated, but the basic vulnerability remains. So could Black Monday happen again? Could we see a 22% single-day decline in modern markets? The honest answer is, probably not exactly the same way, but something similar is possible. Circuit breakers would likely halt trading before losses reach 22%, at least preventing it all from happening in a single day. The specific mechanisms that caused Black Monday portfolio insurance, and the particular form of program trading used in 1987 no longer exist in the same form. Market infrastructure is more robust. Regulators and central banks understand better how to respond to crises. But markets are complex systems, and complex systems can fail in unexpected ways. New technologies create new vulnerabilities. High-frequency trading, algorithmic trading, the interconnections between different asset classes and different global markets, all of these create potential for cascading failures. The next crisis probably won't look exactly like Black Monday. It will have its own characteristics, driven by whatever technologies and market structures exist at that time. But the fundamental dynamic, fear feeding on itself, selling pressure overwhelming buying interest, mechanical systems amplifying decline, can happen again. The lasting gift of Black Monday, if we can call something so painful a gift, is awareness. Market participants, regulators, and policymakers understand that crashes can happen, that they need to be prepared, that systems need safeguards. This awareness isn't perfect protection, but it's better than the complacency that preceded Black Monday. We know now that markets can fail catastrophically. We've built systems to try to prevent or limit such failures. We've learned how to respond when prevention fails. These lessons, bought at the price of $500 billion lost in a single day, have made markets more resilient, though never perfectly safe. And so we've travelled together through October 19th, 1987, through the rise and the fall, through panic and recovery, through fear and resilience. $500 billion vanished in a single day, but something else remained: human capacity to endure, to learn, to rebuild. The markets recovered, the systems were reformed, the lessons, hard-won and painful, shaped the decades that followed. But our story is really about something deeper than markets or money. It's about how we respond when the world we understood suddenly shifts beneath our feet. It's about the difference between panic and patience, between fear and wisdom. It's about learning that fragility and strength often exist together, that systems can break but also be repaired, that the worst days eventually give way to better ones. Wherever you are right now, in whatever quiet space you found tonight, let these stories settle gently around you. Black Monday is long past. Those who suffered through it have mostly healed. The markets that crashed have risen to heights no one imagined possible. The story continues, as all human stories do, with setbacks and recoveries, with lessons learned and sometimes forgotten and learned again. Take a slow breath. Let your eyes close if they haven't already. The numbers and dates and mechanisms, let them drift away now. What remains is simply this: we endure, we adapt, we continue. Sleep well, dream peacefully. Tomorrow is already here, soft and waiting. Good night.